very much a sort of late 90s type market.
Macroeconomic data is not being considered as seriously as the likes of Nvidia results, which to me is bonkers.
At least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks.
The longer the Fed keeps rates higher, the higher the odds that we see a meaningful slowdown in growth.
The Fed is in no rush to remove the policy firming that they've put in place over the past 2 years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market little changed on the S&P 500. Big morning, big couple of days for the US retailers. Kicking things off this hour with Macy's and Lowe's. Then on to tomorrow, TGX, and after that, Best Buy. Lowe's, Bramo, crossing the Bloomberg right now.
Yeah, what we're seeing is a host of earnings, and we'll parse through those numbers. But what people are looking at right now is the potential for some indication of whether the blip that we got in January was just a blip or something greater. What they do see is actually below estimates, seeing full year total sales of $84 billion to $85 billion versus an estimate of $85.6 billion.
Macy's up next. We'll get to those numbers in just a moment. Speaking of the retailers, let's talk about the supermarket chains and the trouble between Kroger and Albertsons facing a challenge. Very, very predictable challenge down in Washington, D.C. Washington says it will hurt the consumer. This is what the company's got to say for themselves this morning. If the FTC is successful in blocking this merger, it would be hurting consumers and helping strengthen larger multi-channel retailers such as, drumroll, Walmart, Amazon, Costco.
The very companies that the FTC is actually saying that they want to try to rein in. But, Jonathan, as you say, this is just no surprise. Add Kroger and Albertsons to a list of companies and potential tie-ups that this FTC has gone after. What we've seen is a more robust engagement from this FTC and DOJ when it comes to cracking down on antitrust. So this is going to go on for a few months. And Bloomberg Intelligence says it's basically a coin toss. 50% whether or not this goes through or not.
If we can't make this happen, if we can't make JetBlue Spirit happen, how on earth are we going to make Capital One Discover happen anytime soon?
Everyone's watching to see whether this is actually going to be allowed, because if two grocery stores that might otherwise go out of business, one of them, or struggle certainly versus the Walmarts, the Amazons, can't get together, and if they're citing certain things like being able to negotiate better with labor unions and things of that nature, we're talking about a game changer for the M&A space. And you're already seeing a lot of commentary saying how many companies, how many Berkshire Hathaways are not interested in making any kind of acquisitions because, frankly, what's going to get through?
It can't get it done. In the equity market, we talk about bigger being better. In Washington, they just talk about big being bad. And that's it, bottom line. I think we often talk about Senator Warren. Senator Warren's got company, not just within her own party, but maybe even across the aisle. And I think that's pretty interesting.
Yeah, it is. She has across the aisle with, like, Senator Josh Hawley. Also, yesterday, what we saw is a release of this letter, 13 lawmakers joining Senator Elizabeth Warren about Capital One Discover. And then also, Senator Elizabeth Warren sent a letter to Secretary of the Defense, Lloyd Austin, about concerns about any M&A, which I haven't seen any as of late, but any M&A in the defense industrial complex, which makes me think across the scope of sectors, she does not want to see a merger. And she's getting ahead of it.
So this was the rant over the weekend. Just giving it to you. In brief, don't worry, it's going to be a short. But here's the question. How many of the big companies that are dominating now are benefiting from all of the M&A that they did before? And how many companies are smaller and struggling now that cannot get in the game because a lot of this M&A is prevented?
Well, you ranted about Mark Zuckerberg and Meta again over the weekend. Is that what that was about?
It was really, you have to call me out.
I'm just trying to work out who the rant was aimed at.
Yeah, sure. There's the Instagram issue, but there's also all of the small acquisitions that just build up tick by tick. What's
True.
Kosher and what's not? I mean, how do you define that?
Still trying to work it out down in Washington. Bottom line, big, bad. That's it. There seems to be no nuance in between. Equity futures right now on the S&P 500, just about positive by almost 0.1% on the S&P. Yields going almost down a basis point to 426.97. There is some price action in foreign exchange away from the euro. I'll be talking about dollar yen in about 25 minutes, so look out for that. Through the next hour, we'll be catching up with Katrina Dudley of Franklin Mutual Series with the US equity rally stalling ahead of key data this week. Terry Haynes of Pangea Policy as President Biden invites congressional leadership to the White House to try and avoid a government shutdown. And the brilliant Hugh Van Steenis of Oliver Wyman as we approach 1 year since the collapse of SVB. We begin with our top story this hour. The US equity equity rally hitting pause ahead of a busy week of Fed speak and data. Katrina Dudley at Franklin Mutual Series saying it's time to diversify. Quote, the percentage of the market represented by tech stocks is close to 30%, but only represents 20% of the earnings. We aren't bearish tech per se, but we do think it's time to diversify where there are cheaper valuations with good growth prospects. I'm pleased to say that with us in New York around the table, Katrina joins us now. Good morning, Katrina.
Great, good morning. Thanks.
Let's get into this. My number one question this morning, what on earth do you do if you've missed this rally? Not just last year, but again so far this year as well.
Look, I think that it's not that we're advocating that you suddenly divest the Magnificent Seven. I can see this being, we look at NVIDIA and we look at the fact that they beat revenue expectations and earnings expectations. But what we're saying is, why don't you go shopping in like the 490 other stocks that exist in this market? And I think, though, the interesting thing is with the Magnificent Seven, it really you haven't been paid to be a stock picker. You kind of bought that basket of 10 and you were fine. With the 490, you've got to pick your stocks and you've got to pick your points and you've actually got to start doing research. And I've been a research analyst my entire career, and that's what we like doing.
Well, this is really the key for a lot of people. They're saying time to do research, time to go into maybe less loved sectors like consumer cyclicals. But I'm looking at Lowe's earnings right now, coming in disappointing. I'm looking at the retail data from January, very disappointing. Does that give you pause to go into some of these cyclicals?
Yeah, I think where we're seeing pause is in some of these lower-end consumers. So you look at something like a McDonald's that came out and said that they're seeing that pressure. And so what we need to see is we need to see a little bit of the wage increase. We're seeing a small amount of wage increases, but we actually need to solidify and shore up that low-end consumer. And once we shore them up, I don't think we're going to see this weakness. And I think that we can have less of this dichotomy between the macro story and the micro murkiness.
The good news, good news, good news, bad news, bad news, good news. The reason why I'm going here is because yesterday we saw yields in the 2-year go up to the highest levels since November of last year, certainly since the previous Fed meeting, and yet small caps outperformed. Do people not care anymore?
Look, why are small caps outperforming? Number one, valuations are cheaper. So you can kind of, you get access to great end markets at much more discounted valuations. Number two, we are onshoring, and that's really accelerating. And you look at what's happening in China, you look at what's happening in Shein and everything in terms of we're really concerned about that. So going for your domestically focused small caps makes sense from that perspective as well. Finally, you've got some of these small caps that are actually saying, you know what, we really don't want to keep raising debt. You're going to start to see them raise equity potentially, and really they're going to solidify those balance sheets. And we were just talking M&A, but they're the companies that can do M&A because they're small enough.
It's true.
You just look. I mean, we were talking. We've got things like a McGrath, which has been bought by Will Scott. You have no idea what they do, but they rent mobile office space and classrooms. And the FTC doesn't seem to be worried about those type of companies because they're smaller and they're not going to generate the headlines.
I love that. That's the cheap guide to getting a deal done in Washington. Have you ever heard of the company?
Nope.
Done. Can we talk about how insulated this equity market is to rates? That's what Lisa was getting at here, and I do find it interesting. How insulated are we, and why are we so insulated to weekly moves in rates in a way that maybe we weren't 3-4 months ago?
I want to say it's the telegraphing that's been the big difference this time around. I mean, you look at what the Fed is just continuing to tell us, data dependency, and we are watching that data. We look at this kind of triangle, as we've talked about it, between inflation and growth rates and interest rates, and they're the three prongs of that triangle. In terms of inflation, that's coming under control, but we do think it'll be slower to normalize at the rate that the Fed needs. If we look at growth, it's continued to be strong, and the final, kind of the third leg of that stool is interest rates, which the Fed have said we're just waiting. We're going to be patient. And if you listen, that's exactly what they've been doing.
We've pushed out the timing. The Fed's done that. It's been reinforced by the data. We've reduced the magnitude of cuts this year as well, and yet still this equity market is rallying. And some of the bulls out there are hopeful, super constructive that we've had this handover from a Fed-driven market to an earnings-driven market. Would you endorse that as well? Do you think we have had that handoff?
Yes, if I have a look at any type of rate cuts, we're looking about a rate cut as being more supportive. and really just supporting the economy instead of a rate cut being in response to very bad data coming out. And I think that that's a very different narrative, and that's really what the narrative has shifted to. If we go back 18 months even, we were talking about recession fears, and so we were talking about rate cuts as kind of being the offset to recession. Now we're talking about rate cuts in kind of a more like, well, they just can take their pedal off the accelerator.
Which is the reason why it's sort of this virtuous cycle. It's sort of the Fed will give if things are good, and the Fed will give if things are bad, maybe even a little bit more. Some people are saying because of valuations, the U.S. looking less good and the rest of the world looking more attractive. Do you buy into this, or do you think that the U.S. is going to retain the bastion of growth in an otherwise real slow-growing world?
So let's think about why the U.S. is this growth engine. I mean, I always talk about the fact in the United States, it's okay to fail. I mean, it is actually a badge of honor to have launched 3 startups that did not work. And so we have this culture of innovation. And that is what has driven us to create so many large cap dominant tech peers. Yes, they were supported by a little bit of M&A, but by and large, they've built these companies. You just don't have that outside of the United States. You do have some good franchises, but there are areas that we're a little bit worried. If we take a look at something like a Novo Nordisk and the percentage of the Danish stock market that it represents in just one stock, it's much more risky than, for example, the Magnificent Seven and the percentage of the stock market they represent here.
But the risk to that concentration in the United States is still quite large. I'm looking at the geopolitical risk for all these companies. 90% of them, in terms of their chips, are tied to Taiwan. Are you concerned about these kind of risks?
I think what we're seeing is that they're really addressing those already. I mean, unfortunately, it just takes time, but time will cure that problem as they reshore that manufacturing here. And that's one of the good things. If you take a look at, a problem, if time can cure your problem, you've just got to wait it out. So I think that that's what we're seeing in those markets.
Katrina, good to see you. Great. Thanks for dropping by. Katrina Dundee there of Franklin Templeton. Way too much bullishness. So this is from Marko Klanovic of JP Morgan. Just to set things a little bit more balanced this morning, Bramo. You'll appreciate it. Inflation risks are skewed to the upside given loose financial conditions, tight labour markets, easy fiscal policy, which could keep the Fed higher for longer. We believe. Here's the punchline. Heard this from Marco last week as well. There is a risk of the narrative turning back from Goldilocks towards something like 1970s stagflation.
Well, and he's not alone. And if you look at the margins, no one's willing to say 1970s, but they say it in other sort of softer ways. Housing might be reaccelerating, housing prices ticking up. We're a little concerned about the bottoming out of this commodity cycle, things ticking up. I mean, you hear about it on the margins, but no one's willing to get that bold because it basically exposes you to all sorts of criticism.
What like? Are you saying you've received some of that criticism
Never.
yourself?
No, no one has ever accused me of being overly pessimistic and skeptical of the world.
Equities right now just about positive by 0.1% on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The U.S. Federal Trade Commission has sued to block Kroger's $24.6 billion takeover of Albertson. The regulator joins 8 states and Washington, D.C. in opposing the deal. They're arguing it would eliminate competition and lead to lower wages and higher food prices. The merger would be the biggest U.S. grocery deal in history. Together, Kroger's and Albertson would have nearly 5,000 stores across the country. Expedia is cutting about 9% of its workforce as online travel company attempts to revive growth and regain market share. The Seattle-based firm will cut about 1,500 jobs across the globe, with some affected employees notified on Monday. Earlier this month, Expedia reported disappointing holiday results and issued a weaker than expected outlook for the current quarter. It also announced a leadership shakeup. Alphabet shares fell almost 4.5% on Monday on renewed fears the Google owner's missteps in AI are putting its search business at risk. The company paused Google's image generation feature last week after criticisms over inaccurate historical depictions of race. Analysts have warned the problems may fuel a perception that Google is an unreliable source for AI and may create an opening for competitors. That's your Bloomberg Brief, John.
Danny, thank you. So much to say on this a little bit later in the programme. Are they putting ideology before facts at Google? It's a big question. Up next on this programme, another government shutdown deadline fast approaching.
The deadline to avoid a partial lapse in government funding is fast approaching.
Even a partial shutdown would mean chaos and pain for the American people.
That conversation coming up next, live from New York City. Good morning. Live from New York City, equity futures on the S&P 500 bouncing back just a touch by 0.1% on the S&P. After 3 days of gains, we snapped that yesterday in the equity market. Yields a little bit lower by a single basis point, 426.58. Under surveillance this morning, another government shutdown deadline fast approaching.
The deadline to avoid a partial lapse in government funding is fast approaching. Without action by Friday, the country would face needless disruptions.
We want to avoid a government shutdown. We want to work with all our House counterparts to spare the American people of the pain that a shutdown would bring. Even a partial shutdown would mean chaos and pain for the American people.
Here's the latest this morning. President Biden meeting with 4 congressional leaders at 11:30 today to try and make a deal to avoid a looming government shutdown on Friday. The next deadline is a week later, March 8th, when a full shutdown would take place. Terry Haynes of Pangea Policy writing this: the White House meeting will show that Washington doesn't want to be fiscally responsible and is paying no attention to increased market concern and dismay about the United States' fiscally unsustainable path. Terry joins us now for more. Terry, what are the odds that we avoid a shutdown and this speaker keeps his job?
I think the odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that they kick the can for a week or two with some more temporary spending to try to work out problems. There's also the optics, even for the Republican purists who are charging a lot of this. The optics of having a government shutdown either right before or right after the State of the Union address. Now, I have no doubt that some of them might like that, but the optics are terrible for Republicans who are thought by the public to have a better economic handle than the Biden Democrats. So I think this probably passes. But the bigger question is, this is going to bumble on for a month or more, with the idea that by April 30th, there are mandatory 1% cuts if they can't come to a deal. So those same Republicans think their leverage grows.
Well, that's what I wanted to ask you about. How much do we just end up at April 30th, and then we get this 1% cut across the board? And I guess for the Republicans, they don't get some of the policy riders they want in terms of these provisions, but they do get the cuts. Would that be a win for them?
Some of them would see it that way. Yeah, I think so. And, but also what I would say principally for markets who would be concerned about downturns in defense spending, for example, is that you'll have a 1% cut, of course, but then what you'll end up with are some kind of exemptions or workarounds so that defense spending doesn't go down. I mean, that's just my primary example here. What you're going to get is kind of a muddle for the next 6 to 7 weeks and a hodgepodge of results.
What do you think we get out of this meeting today? Biden having the top 4 legislative leaders over today at the White House, but the shutdown is midnight on Friday. Is it a little bit too late?
Well, I think it's like most things in politics and many things in markets and in life. It's a lot of it's posturing. Biden finally wants to be seen as doing something as a preview to the State of the Union. I think you get mixed results, frankly, for markets. You get kind of a plus on the foreign aid and U.S. global leadership box because you're going to see, with the exception of House Speaker Johnson, you're going to see the vast majority of Congress focused and pushing on getting aid for Ukraine, Israel, and the Indo-Pacific. I think the little bit of negatives are the shutdown, frankly, for markets for the fiscal reasons that I mentioned.
Although markets don't seem to care. Is this something that markets are going to wake up to, or is this basically something that no one asks you about, but they kind of have to keep an ear out just because check off the boxes?
Yeah, like 15, 20 years of this. I mean, inside the Beltway, it's, kind of the usual towel snapping, who said what to who kind of stuff. But, markets really don't care about this. Markets will start to care if it starts to affect, let's say, the defense supply chain, kind of real time issues. But, the markets are in on the joke and have been for some time. They know that what will end up happening is just Washington will end up backfilling whatever hole they create.
There might be more of a response to this aspect. President Biden saying yesterday that it seems like there's some sort of agreement to pause fighting in Gaza for the near point. He was saying, my national security advisor tells me that we're close. We're not done yet. My hope is by next Monday. Would that have a material effect? Does that mean something to you in concrete terms?
What it means to me is that the president wants to continue to look relevant in those negotiations and in the Middle East generally in the run up to the Michigan primary more than anything else. I mean, it's not lost on anybody down here that the reason why he says this the day before the primary is he's trying to head off a problem with getting large numbers of uncommitted votes, and they are called uncommitted votes, in that primary that might make him look weak or cast aspersions on the administration's Middle East policy.
Terry, what is the bar for the president in that primary? What does success or failure look like?
Well, I mean, obviously, John, he's going to win, but I would say if you get uncommitted votes in double digits, by which I mean double digits, 10% or more, it's going to look like the White House has not been is weak in terms of its core voters, first of all, and secondly, that it's not messaging. And normally I kind of give the back of my hand to messaging concerns as secondary. But in this case, what the White House really needs to do is forthrightly tell the public and tell them repeatedly what we're for, why we're for it, and what we're doing about it. This president could do with a little less box ticking for all the coalitions and a little bit more standing firm and telling people why we're doing what we're doing.
Given today is just a primary, these uncommitted votes, which this group is trying to get to 10,000 to show that margin of Trump and Clinton 2016, when you look out to November, potentially they come out and vote for Biden. How many can he lose in this Arab American community and still get it across the finish line in Michigan?
Oh, I think probably quite a lot. I mean, there's no serious opposition in the primary, number one. Number two, Michigan is always considered a swing state, and you all have done some very good reporting on the idea that Trump voters tend to come from traditional Democrat middle-class union households. At the same time, I think that, firstly, there will be a big Biden get out the vote effort. Secondly, my call on Trump continues to be that he's weak because he's not consolidating the party, he's not getting the party behind him, and he's losing a lot of independent voters. So, I think they could stand to lose a fair number of Arab American voters in the final analysis and still come and still pull through.
Terry, what you just said, the perceived weakness of the former president going to the national level, was that reinforced by the results from South Carolina over the weekend?
Yeah, I think absolutely. I think what you end up seeing is kind of a party split, somewhere in the 50-50 to 60-40 line. Even in a strongly Trump place like South Carolina, he couldn't get to 60%. He was barely under it, but I mean, he couldn't get to 60%. And I think that carries through both in terms of Republican voters, Republican kind of grandees, I mean, including people that have served in his first administration, who are going to be strongly against him and will say so repeatedly and motivated to. And then you have the problem with the independents. And he knows he's weak. I mean, one of the many reasons you can see that is how quickly he came out on IVF. Right? I mean, he's seeking to separate himself from the party on that and trying to make up ground with independents who probably have already made up their minds against him anyway.
True. Such a good point. Terry, good to catch up. Terry Haynes there of Pangea Policy. On the surface, it looks absolutely dominant. Annmarie, we're talking about double-digit wins. Iowa, New Hampshire, South Carolina. You get into the nuances of it. Terry's view, it's not that dominant.
Well, Terry shares the view of a lot of individuals who are looking at the voters coming out of these primaries. And when you look at Republicans who lean a little bit more independent, or if it's an open primary and they didn't vote in the Democratic vote and they are independents, they want an alternative. And Trump is just at 60% in South Carolina. That's closer to 50% than 100%. What it shows is that he has the base and he has a lot of work to do to general. I think what President Biden is going to show potentially today with these uncommitted protest vote, let's see what the numbers show, is that they need to do a lot more to shore up some of their core voting bases that they had in 2020.
Super Tuesday. 1 week away. Equity futures right now on the S&P 500, slightly positive, up by about 0.1% on the S&P 500. Coming up on this program, US regulators issue a scathing assessment of Boeing's safety culture following the nearly catastrophic incident earlier this year. That conversation up next from New York. This is Bloomberg. snapped a 3-day winning streak on the S&P in yesterday's session. Small day of losses. This morning, small day of gains, up by 0.1% on the S&P, up by 0.15% on the Nasdaq. This hour, littered with earnings. We had lows a little bit earlier. We'll have Macy's later this hour. We'll break those down for you in just a moment. In the bond market, 2-year, 10-year, 30-year. Ton of issuance yesterday. We'll get a 7-year issue a little bit later today. Yields were pushing higher through the curve, the 2-year. Just south of 470 at 469.12. We're down about 2 or 3 basis points there on a 10-year yield, 427.37. Basically unchanged. It's not just the Treasury supply we need to keep an eye on. Also need to talk about corporate credit supply. Bramo, what a month so far in February.
It's been record across the board. And it's not just investment grade. You're also looking at some of the lower rated companies as well that are issuing debt. And spreads are still at the tightest levels going back for basically a year. So what you can basically say here and infer is that all that cash on the sidelines that people keep talking about is going somewhere. And maybe, you know, this is the haven.
I think I saw the headline yesterday. It was the busiest month going back to April 2020. April 2020 was a different world. You're rushing to issue debt. Spreads have gapped wider off the back of the pandemic. We're issuing debt for survival, for the purposes of surviving through the shutdown. And here we are a few years later, and we're talking about spreads being incredibly tight. This debt is being gobbled up, even with rates at multi-decade highs, with no sign, at least in the next several months going through June, of this Fed itching to cut rates anytime soon.
So 2 things here. Number one, in April 2020, it was fueled by this feeling that the Fed had your back and that they were going to cut rates to zero. So even though spreads were wider, the all-in borrowing cost was rock bottom. Now we're talking about companies where the all-in borrowing costs, even with really tight spreads, are not that low relative to where they've been historically, and yet companies still can issue debt. And still some of the investors are coming out and saying, you look just as creditworthy, if not much more than you did before, and you can absolutely pay it back. This is the most bullish market, considering where we came and how much people were pessimistic that I can imagine.
This moment is very different to where we were 4 years ago. I'm going to do my best here to make foreign exchange interesting for you.
It is actually.
Good.
I have interest today.
Good. I've got stuff to say as well. So I'll say my stuff, and you can say your stuff.
That sounds great.
In just a moment, OK? Is everyone ready for this? The euro, unchanged, 108.55. But Kit Jukes of SocGen says it could get interesting. This is what Kit's got to say about it. Whether the Fed or the ECB cuts first or fastest will determine where euro-dollar goes this year. But if they are both moving in the same direction, the pair won't go very far in either direction. However, here's the however, bear with me. If it were to become clear in the months ahead that the Fed's next move will be a hike, while the ECB's will be to cut rates, then the FX market reaction will be substantial. A return to parity, in quotes, would be a clickbait title, but would demand a painful revision to our forecasts on the euro. That's the euro. That's all I can do with that, OK? Park that there. Dollar yen, Kit Jukes, 150.36. Kit says the BOJ has everything it needs to act right now.
We saw higher than expected inflation come in Japan at 2% versus the expected 1.9%. What you're seeing right now are 2-year yields in Japan at the highest levels going back to 2011. And this statistic really got my attention. The likelihood of the Bank of Japan exiting its negative rate policy by April has risen to about 81%. That is the expectation baked into markets. The fact that the currency is moving as little as it is tells you how much people have been burned by this. But nonetheless, we're watching.
On the edge of excitement in the FX market, just getting a report from our team here at Bloomberg. We've just obtained a draft communique of the finance chiefs getting together over in Brazil. This is the G20 get-together in Latin America. They say upside risks include faster than expected disinflation. The likelihood of a soft landing in the global economy has increased. Who are we thanking here? The United States, because I don't think we're thanking Europe, are we? And we're certainly not thanking China either. Maybe for China, we're thanking them for the deflation.
100%.
Possibly.
Commodity-driven.
But the growth story looks stateside. The deflation look to Asia.
So basically, thank you to China for the disinflation in commodities, and thank you to the U.S. for the engine of growth. You put those two together, and it's nirvana. But people are getting nervous that maybe we're getting a little bit ahead of ourselves with just how quickly the disinflation is going.
There's 2 hot wars right now, and yet Brent is still at $82 a barrel. This all has to do with Chinese demand, which has not come roaring back since the depths of the pandemic.
That's the outlook from the G20, the latest draft communique just moments ago. Under surveillance this morning, our top stories. President Biden expecting a deal for a ceasefire between Israel and Hamas to start as soon as Monday. Discussions have intensified in recent days for an agreement which would secure the release of more hostages held in Gaza. Israel and Hamas have yet to comment. Israeli officials continue to say they will launch an offensive in Rafah near the border with Egypt soon. Netanyahu has said repeatedly that they're making delusional demands. So why is the president constructive here, Lisa, when ultimately what you hear from the Israeli leader is less encouraging?
What did we just hear from Terry Haynes? That this is very deliberate ahead of the Michigan election, considering the fact that it has, I believe, the biggest concentration of an Arab American population in the nation.
It does, and more than 100,000 Arab Americans came out and voted in 2020, and today is going to be very much a protest vote. So Biden may be using foreign policy to try to shore up some of these critical bases he has in the Democratic Party. But also, the president joined Seth Meyers last night after he was walking around with him, eating ice cream, talking about ceasefires. And he said Ramadan's coming up. And there's been an agreement by the Israelis that they would not engage in activities during Ramadan as well. So Ramadan is March 10th. So basically, I think we have Monday to Sunday of next week. If an agreement were to happen for a hostage deal, it would come within those days.
A top tip for politicians: don't talk about ceasefires holding an ice cream. Just don't do it. You knew what kind of questions you were going to be asked. Don't put the president in that kind of situation. Don't be in that kind of situation. Don't answer questions about the war holding an ice cream. It's absolutely ridiculous.
There have been a lot of questions. I just wonder about the handlers. I mean,
Totally
at a certain point, I mean, this is why you have people around you that try to craft your message, like my people who always were trying to craft my message every day.
We're here to protect you.
Thank you. Is that what you're doing?
It's the optics. The optics are just absolutely dreadful.
But the journalists aren't going to go ask him what ice cream he's eating. They're going to ask him a question that they've been wanting to ask all day, and that was the moment they had close to him.
And the handlers should know that. So don't put him in the situation where he's eating an ice cream, answering questions about the war in the Middle East, especially when you know you've got something to say as well. Here's another point down in Washington on antitrust. The Federal Trade Commission and 8 states plus Washington, D.C. are suing to block what would be the biggest U.S. grocery deal in history. The complaint saying Kroger's purchase of Albertsons would lead to lower wages for workers and higher food prices. Together, the companies would own 5,000 stores across the country. The supermarket chain saying the deal is needed to compete with Amazon, Walmart and Costco. Kroger and Albertsons first announced the agreement in late 2022, and there is no end in sight to this saga.
And people are watching this because they want to hear about Capital One and Discover, because they want to understand what the potential is for elsewhere. I keep going back to that cash pile at Warren Buffett's Berkshire Hathaway. And the reason why is not because it's a shocking number of more than $160 billion. It's that where are you going to go? What can you buy? Is it going to be more kind of M&A overseas than even in the United States? Because if you're too big, the answer is no.
Yourself is the answer, apparently. You know, if you have that much money, you buy yourself. Buybacks. Which is what a lot of the big tech firms are doing, right? What other choice do they have?
It's true.
They can buy chips from NVIDIA.
Right.
Or they can buy themselves.
They can... It just sounds, you know, it's a wonderful way of putting share buybacks and repurchases.
Yeah, I mean,
but,
okay.
you know, if I had...
That's the latest on that. I'm pleased that crashed and burned. All right, I'll move on to Boeing. US regulators issuing a scathing review of Boeing as the fallout continues from the mid-air blowout during an Alaska Air flight last month. The FAA saying the company has ineffective safety procedures and suffers from a breakdown in communications between senior management and staff. Boeing responding in a statement saying, quote, "We will carefully review the panel's assessment and learn from their findings as we continue our comprehensive efforts to improve our safety and quality programs." Bloomberg's Brooke Sutherland joins us now for more. Brooke, you're not getting a combative Boeing. They're listening. They know they've got to respond. They know they've got to fix it. I want to give you credit. You came out early and talked about the culture, that something was wrong within this company. What are we learning from the regulator and the people conducting this review?
I think, to your point, they are saying the right things now, but it would have meant a lot more if they had been saying this earlier. And they had plenty of opportunity to do that in the wake of the 2 MAX crashes. And I think what's important to note here is this report was started in March 2023. They didn't start this investigation into Boeing safety practices because of what happened with Alaska Airlines. That was a symptom of a culture that is just lacking. And when you read this, the crux of it is really, how do you figure out how to get bad news to the people that can do something about it before it morphs into a crisis? How do you flag problems before you have something like Alaska Airlines happen? And this just goes back to the basics of how you run a manufacturing company. It shouldn't be that hard, but I think in practice it is, not just for Boeing, but for some of these other companies that have sort of lost sight of what they really do, and that is manufacture products. I think about GE a lot just because these companies do share so much overlap from their executives over the years. And you look at the transformation under that company, and CEO Larry Culp is known for being extremely hands-on, for being very invested in what happens on his factory floors. At Boeing, Dave Calhoun is known for being the opposite, of being more hands-off. I don't know if that's what Boeing needs right now. I think you really need somebody to get in there and to pay attention to what's happening with these manufacturing processes, because I think the people at the factories pay attention to that. They pay attention to what the executives are saying and what they're doing. And when you move your headquarters to Arlington, Virginia, even further away from that 737 factory outside of Seattle, I do think that sent a message.
Interesting. So, Brooke, let's talk about personnel. Tell us about the changes that have happened and the changes that you'd anticipate to happen in the coming weeks and months.
At Boeing specifically, I think, there's been a number of different changes. If you look, sort of over the time period in the wake of the MAX crashes, we've seen sort of a revolving door of executives. And yet I still don't feel like, and if you look at this report, that they have their hands around, what exactly is wrong here with the culture. And part of it, just to go back to your initial point about, they're saying the right things now, but we have not ever heard from Boeing top management, we have a culture problem. They've been very reluctant to say that this is some sort of systemic issue. And, the reasons for that are perhaps obvious when you're talking to analysts and investors. But I do think, addressing this problem starts with calling it out and accepting it and really being willing to get your hands dirty and dig in and figure out how you solve this.
Well, regulators seem to have attempted here, just to give some details on what they found. Constant changes to complex procedures and trainings leading to confusion. Other shortcomings hindered the average employee's understanding of their role and how Boeing manages safety. I mean, this is pretty basic. And then it said that regulators requested information that Boeing demonstrate commitment to safety because the materials it received, quote, did not provide objective evidence of a foundational commitment to safety that matched Boeing's descriptions. Can Dave Calhoun remain at the head of a company where you have this type of scathing description from U.S. regulators trying to understand why there have been repeated errors and repeated incidents?
I think you have to think about the incentives of the different players here. And I think what makes Boeing so unique is that it exists in a duopoly, that you are never really going to have the type of accountability at Boeing that you might have at another company, simply because the world cannot exist just with Airbus airplanes. You do have some planes coming out of China, out of COMAC, which had a pretty impressive showing at the Dubai Air Show, but you're just never going to see the Western world buy those planes. And we just cannot live in a world where there is only Airbus. And so I think, you've seen customers come out and be a lot more aggressive in their criticism of Boeing in the wake of the Alaska Airlines incident. But at the end of the day, they also want their airplanes. And so I think it's going to be really interesting to see just how much pressure there ultimately is on Boeing to change its ways, because I think you could argue that in the wake of the MAX incidents, there wasn't enough pressure, or certainly Boeing didn't feel it for the FAA to now be able to come out with a report like it just did.
The CEO will be sitting down with the head of the FAA today. What do you expect? Anything tangible to come from that, Brooke?
I think it'll be interesting to see how much they actually share about what's discussed in that meeting. I think, if Dave Calhoun wants to show that he's taking this seriously, they should come out with something tangible. And it needs to be real. I mean, we've heard about changes from Boeing, to ways in which they've improved their safety culture. I think it needs to go beyond that. I think you need to really get specific and talk about how you're going to address some of these issues that were raised in the FAA report. I mean, I think that's what they should do. Now, how much they'll actually talk about changes that they're making or what was discussed, we'll have to see.
Brooke, appreciate the update. Thanks for being with us. Brooke Sutherland there of Bloomberg on the latest with Boeing. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Altice gained as much as 63% on Monday after Bloomberg reported that Charter Communications is eyeing a takeover of Altice. Sources say Charter is working with financial advisors to assess the deal, but could still decide not to pursue it. Both firms are coping with wireless competition and cord cutting. Zoom reported better than expected quarterly sales and profit with strong demand from corporate customers. Sales gained 2.6%. Enterprise revenue was up 4.9%. Zoom also announced a $1.5 billion share buyback. After hypergrowth during the pandemic, Zoom has experienced a dramatic sales slowdown. President Biden defended his mental fitness and took a jab at former President Donald Trump in an appearance on Late Night with Seth Meyers.
Number one, you got to take a look at the other guy. He's about as old as he can't remember his wife's name.
Yeah.
And number one. Number two, it's about how old your ideas are.
Biden has been trying to alleviate fears that he is unfit for a second term. A January NBC News poll showed that 3/4 of voters, including half of Dems, say they are concerned about Biden's age. Less than half say the same about Trump. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Now, my best guess is, and this can change, is that there won't be debates going into this election this year. But if there are, I think maybe that is basically the warm-up act. Can you imagine how dreadful it is? You want to hear a conversation about policy. Can you imagine the debate if that's the road we're going down? If it's just going to be an exchange of insults over how old each individual is?
It's going to be a food fight.
Well, I don't think it's going to happen, and I think that we're going to be spared from whatever that would look like. But yeah, it wouldn't exactly be some sort of comprehensive look at how we can reduce our deficit.
No. That's the latest on presidential politics. I'm not sure that's popular on late night TV. Up next on this programme, nearly a year on from SVB's collapse.
For investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. They're nervous about growth in banks too quickly.
That's coming up next, live from New York City this morning. Good morning. Live from New York City, equity futures on the S&P positive here by 0.1% on the S&P 500. In the bond market, yields lower by a single basis point, 427.17. A little bit later on this afternoon, we get some 7-year debt. We've had a lot of supply in the Treasury market in the last 24 hours. We'll talk about how well that's been taken over the last couple of days, Lisa. We can also talk about credit as well. Credit supply has been phenomenal, just phenomenal, and taken down really well too.
The auctions yesterday, they were fine, but they came in a little bit weaker. Today's going to be more interesting with the 7-year.
The 7-year test a little bit later on. And the Savannah's this morning, nearly a year on from SVB's collapse.
For investors right now, growth in banks has been kind of tainted with the Silicon Valley failure, Signature failure, as well as First Republic. They're nervous about growth in banks too quickly. Our investors look at growth in this environment, a 550 basis point Fed fund rate as a little bit risky. And so as we are looking for loan growth, we're still hoping, we still are out there meeting our clients' needs and picking up market share. It is harder, as I mentioned earlier, and the investors know that.
Here's the latest this morning. The KBW Regional Banking Index down more than 10% so far this year as we inch closer to the 1-year mark of SVB's collapse. Hugh Van Steenis, the vice chair and partner at Oliver Wyman, writing recently in the Financial Times, saying many of the issues which led to Silicon Valley Bank's failure are left unaddressed in the Fed's proposal for new bank regulation. I'm pleased to say that Hugh is with us around the table. Hugh, good morning to you.
Good morning. How are you?
Always fantastic to catch up with you, sir. Let's talk about this. What should have been addressed, what isn't being addressed, and what vulnerabilities are left from the fiasco of a year ago?
Well, look, I think there are sort of three key things. The first was the asset liability mismatch. There was a lot of interest rate risk. And to be honest, this is something we've seen in the 70s, 80s, 90s. This is what happens with banks. But so interest rate risk. Second was poor supervision. And then the third was depositor concentration. And for us, that was new. The number of these very, very large ticket uninsured deposits and how they ran together. None of that's in the Basel proposals. And in fact, and of course, every time I meet a bank CEO or CFO, Basel comes up. It's almost like the rude word at the table. And they're obviously pushing back against them because it's such an increase in capital. But it's it's the basics of banking. And that's why, in a way, I think for the regional banks, it's probably a 2 to 3 year period for them to readjust. And that's why private credit are having a boondoggle, because this is such a ripe opportunity.
You've talked about this a million times. Can you just frame for us how regulatory regimes are going to exacerbate existing trends and reshape the landscape of Wall Street and the whole banking industry? Can you just go through each phase for us?
Yeah, with pleasure. So in my view, this is probably the third or the fourth big wave of disintermediation. And normally what you find is that you need three things. You need a big financial shock, you need some sort of financial innovation, and then you need the regulators then to try and jump on board to try and turbocharge that. So if you go back to the 70s, I mean, money market funds were only invented in 71. We then had the 73, 74 shock, a bunch of banks failed. That turbocharged disintermediation. And I think what's interesting is, for the first 2 years, it's people prey upon the banks to try and get the loans. When you get the new rules, actually the banks themselves start reinforcing that disintermediation. So, you saw a big wave of corporate loans coming out of the banks in the 70s. Post the financial crisis, it was mortgages and market making. And I think now it's really around mid-market lending, commercial real estate, where I think we'll break through I think there's estimates of private credit being $3 trillion in 5 years. I think we'll massively break through that, given the kind of trends we're currently seeing.
Let's talk about the anatomy of this credit disintermediation, because people talk about the commercial real estate that's on the books of a lot of these smaller banks, and that's restricting their ability to lend. Is that what you're seeing, that these private credit providers are saying, if you can't lend, we will, and we will provide those loans, so the economy keeps chugging along, but the small banks lose out?
Completely. So let's take last year. So leveraged lending, 85% of leveraged loans were funded by private credit rather than the banks. Now, the large banks are back in the game. They've now worked through their hung loans, they worked through their losses. But for some of the mid-cap banks, of course, one of the lessons I learned from the financial crisis is banks can only take the losses they can afford to take. And so, of course, they're hanging on in there, hoping for the best. And that's why, if you look at lending by the regionals this year, it's continuing to fall. And you saw that through the earnings season. It was very weak. So at the moment, they're not actually selling the commercial real estate in size. They're actually selling the good stuff. They're selling stuff in the 90s because they've both got funding issues and capital issues. Commercial real estate's going to take a couple of years to work through.
So Ryan Sweet over at Oxford Economics was writing about this in a report overnight. He said that odds are that the bank stress from offices is far from over because a significant number of loans are due this year and interest rates will decline more slowly than anticipated. How much sort of default and distress are we going to see in regional banks on the path from here to clearing out the bad stuff?
So I think there's pockets of stress, and obviously, but the regulators are clearly trying to encourage the banks to conserve capital, cut dividends, buybacks, and so forth, so they can rebuild. So my base case is it's a grind. It's a real grind, and they'll sell as they can work through. My base case isn't that we get tons more banks. Of course, if we get another shock, that's when things start to become more tricky. But no, I think it's really hard work. And in the meantime, if you're one of the top 5 banks or private credit, you can just seize share. So I think that's where the opportunity. They're really looking to suppress their advantage this year.
This conversation's about how we finance the economy. Can we talk about how investors and what we invest in has got to change as well? I went to that quote at the World Economic Forum of yours. I'm going to use it again about how investor flows are going to polarise into a barbell. This is something you talked about ages and ages ago. At the one end, we'd have passive and exchange-traded funds, benchmark returns cheaply, conveniently. On the other side, we'd be investing in specialist managed investing in private assets and real estate. This trend has clearly taken hold over the last 10 years. Do you think that process is largely complete?
No, I think it's further. Oh no, I think there's significant further to go. And you're very kind to remember a piece of research from 20 years ago. You're very, very kind. But so if we go back then, fees from hedge funds and private equity, and of course hedge funds are a much bigger deal then, were about 27% of the asset management industry. Today they're about 51. I see them going well into the 50s. And you look, I sit on an endowment board. It's clear that we're using the risk budget ever more for interesting returns. Private credit, off the run, quirkier. You see this with some of the largest fixed income investors in the world. The allocations, there's a sea change to credit, as Howard Marks said. There's a sea change to private credit. So I think there's a continuation of that. And at the other end, ETFs remain cheap as chips. So it's it's a lopsided barbell now. So probably for your workout rather than for mine.
I'm selfishly interested from a media perspective as well. It's why I often always look at this and talk about this, Lisa. I think that certain media, business media, still act like it's the 90s. Single stocks, when the world has changed. The world has clearly changed. The way people invest, I always talk about this with Tom. I always joke with him that the Dow is a weather forecast for a town that no one lives in anymore. And I seriously feel this way. I think a lot of people want an update on financial markets. They want to hear about the Dow. What does that actually mean to people anymore if you're not benchmarked, not exposed to it? You're not at that index at all.
Right now, what you see is people, either if they are single names, it's about the technicals as well, underpinning it because of the ETF trading, as much as it is about the actual company, their revenues, and their profit forecasts.
I could talk about this all day. Hugh, it's so great to see you in New York. Let's do this again soon. Hugh Vastinas there of Oliver Wyman. Let's set up the next hour for you. Coming up next, we'll catch up with Skylar Montgomery-Koenig of TS Lombard, Aaron David Miller of the Carnegie Endowment, and Guy Labat of Jenny Montgomery Scott, and the Tanger president and CEO, Stephen Yalof. All of that still to come. Live from New York City this morning. Equity futures positive by 0.1% on the S&P. In the bond market, 426.97 on a 10-year. A ton of economic data coming at 8:30 Eastern Time. Consumer confidence coming about 90 minutes after that. From New York City, this is Bloomberg.
The overall market is still okay. I think the economy is still okay.
The Fed is more likely to simply remain on the sidelines rather than re-engaging in further rate hikes.
The longer that these policy rates stay elevated, the more that they're going to bite into the economy.
The Fed is locked and loaded. So if there is a meaningful slowdown in growth, I think they're going to cut rates.
A market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, a big morning for retailers in America. Macy's right now in the pre-market positive by around about 3%. We've got the results, the outlook, and Lisa, we got some store closures too.
150 namesake stores, but to me what's interesting is, yes, they're going to close these locations. Unclear how many people are going to be affected through 2026, but they're actually adding to a number of outlets with respect to Bloomingdale's and Bluemercury. If you take a look at under the hood, you could see that same-store sales at Macy's namesake brand fell 6%, whereas Bloomingdale's fell 1.5% and Bluemercury actually rose 2.3%. Wealthier shoppers have money to spend. Poorer ones, not so much.
Exactly. And we've seen a lot of analysts around this table talk about the bifurcation of the consumer. Those on the higher end of the socioeconomic scale, they're spending, and they're spending on luxury, and they have all this disposable income, while those on the lower end are starting to feel the bite of inflation. And this plays out perfectly in this Macy's stories. They're looking at the lower end, they're starting to get rid of some of it, and they're looking to some of the higher end luxury products.
The stock trading at 19.30, dancing around in the pre-market, just about unchanged currently. A big hour for the retailers, and we'll be talking about that a little bit later. Can we bring up Google? Take a look at Alphabet in the pre-market. We're doing okay. We're positive by 0.6%. Yesterday, not okay. Down something like 4% yesterday. They've paused the image generation for its Gemini AI model. Elisa, Google has absolutely dominated search. Whether they dominate AI-infused search is a different question, because the early progress, there ain't much of it at all.
Especially because it's a credibility game, that your model is actually going to generate something that has the results that people are looking for. If their Gemini outlet was accused of a different bias, of having a sort of, some people say creating sort of the woke kind of Gemini output, whatever you want to call it, the point is it's credibility and a question of whether people can really lock into this. And it raises this question of, are they going to lose even further from Microsoft as they start to complain that they're sort of dominating in a monopolistic way?
Are they putting ideology before facts? Now, the excuse that they've given, the reason that they've given, kind of makes sense. That if you're in, say, China and you ask for an image of a football team, then you might want some Chinese people in that football team. That seems to be why this has happened. However, that's their reasoning for it. When you start to put in prompts like Nazis in Germany in the 1930s, and you get a diverse set of characters, quite clearly something has gone very, very wrong. Now, the question that's being asked now is, have they deliberately put ideology before facts? And if they have, how on earth can you rely on search with Google? Google is dominant for a reason. If I put something into Google search, I'll get the answer that I'm looking for. If I can't rely on them for that anymore, then what kind of business do they have left?
I don't have intimate knowledge of Gemini. I'm putting that out there as a sort of benchmark. That said, there is a question just in general of all of the artificial intelligence, generative AI types of platforms and the inherent biases that everybody has. And how much are they magnified in the programming of some of these generative AI models? You have to wonder, deliberate or not, what kind of expansion of this technology is there going to be without a full understanding of how our biases are fully put into them?
Whether or not you agree what's going on at Gemini, Nate Silver, I think, nails it. They need to shut it down because it's several months away from being ready for prime time. Why did they release something that was not ready? And he put in his question into this bot, which was, who has negatively impacted society more, Elon tweeting memes or Hitler? And Gemini said it's not possible to say definitively, to your point, Jonathan. But he said, why are they moving ahead with something that wasn't ready to be
How was it rolled out? Was this not tested in-house? And when it was tested in-house, were they satisfied with the answers they were getting? Which raises even more questions.
But again, this goes to the point where we're suddenly banking on generative AI, changing the world and increasing productivity before we fully understand how rigorous the testing has been across the board. Again, this goes to the concern that even people in the industry are saying, can we get ahead of this? Can we put some guardrails on it while still allowing the innovation?
But it's something unique to Alphabet here. We're talking about a company with a near monopoly business. They'd push back against that, I'm sure. But ultimately, a near monopoly business, they've absolutely dominated. I have no idea if this product is going to be good in the future. Maybe it will be. But the fact of the matter is, we are talking about Alphabet being behind in something that we think they should be dominating at, and that is something very, very new. This is a company that is perfectly set up to dominate this and hasn't at all.
This is the reason why people are genuinely worried about a 1990s type of tech bubble, because you have to think that some of the technological advancement is going to be so transformative that it will upend models that have become dominant, but that will no longer be so. And that's the reason why we were talking about Binging, right? That's why we were talking about Microsoft and their generative AI and what they could do to really compete with Google.
Are we talking about Binging yet?
I'm talking extensively about Binging.
That stock is up by about 0.5% after being down 4% in yesterday's session. The broader equity market, equity futures positive by 0.1% on the S&P. In the bond market, yields come down by a single basis point, 426.78. The euro slightly stronger, 108.59. Coming up this hour, Skylar Montgomery-Koenig of TS Lombard on why sticky inflation is good for stocks. Aaron David Miller of the Carnegie Endowment with a ceasefire in Israel gathering momentum. And Stephen Yalof, the CEO of Tanger, on the health of the US consumer. We begin with our top story, the S&P 500 ending a three-day winning streak ahead of a slew of economic data and Fed speak. Skylar Montgomery-Koenig of TS Lombard writing this. Policy is no longer the only market driver, with equities now reacting positively to upside surprises to key economic indicators. We remain constructive on equities. Sticky inflation may delay Fed cuts, but as long as it's caused by demand, it should be good for stocks. Skylar, I'm pleased to say, joins us now. So, Skylar, do you think that explains why this equity market has been able to price out the rate cuts in fixed income and ultimately continue to rally, at least so far year to date?
Absolutely. I think we've had a very good earnings season. We've had 2 quarters of positive earnings growth, which tells me that we're past the earnings recession that we saw last year. You're seeing real wage gains, which points to a strong consumer. But those real wage gains don't necessarily have to mean margin contraction if you have productivity gains as well, which is what we're seeing. And so that positive U.S. growth, coupled with Fed cuts, which will come even if we get a little bit of a slowdown, means that you can have a pretty positive outlook for equities.
You said at the start of the year that maybe the pain trade could be that we don't get the rate cuts. We didn't get the rate cuts when it hasn't been painful. What do you think the pain trade is now?
I think, we've moved quite significantly. And when I talked about the pain trade at the beginning of the year not being those rate cuts, I didn't mean so much for equities. I was talking about the dollar specifically. So I think we have had a bit of that pain trade in terms of a very strong dollar on the back of these rate cuts proceeding. I think from here, the big worry is if we get an inflation resurgence, and that inflation resurgence is supply driven rather than being demand driven. And that supply driven resurgence would be very bad for equities and it would be very bad for bonds. And so that's really the pain trade to me. I don't think it's the base case, but it's something to watch, certainly given the shipping disruptions as well as everything that's happening in the Middle East.
Skylar, one thing that I loved about your report was how closely you dug into all of the earnings results and just how strong some of these companies were. You point to margins remaining elevated. How much is that really tied to the commodity cycle that we've seen go in the opposite direction of what so many people were expecting?
Yeah, I mean, it's certainly playing a role, the fact that we've had margins be very, very healthy, right? So what we had was margin contraction through most of last year because you had real wage gains, you had CPI not being as strong as previously, as in consumers have been pushing back on these stronger prices that we've had. But on the positive side is that you've had this PPI decline, and it's been quite significant. So we have had kind of an upside surprise there in the most recent data, but it looks more of like a normalization back to average levels than it looks like something that's very worrying. So certainly if we got commodity prices rising again, or resurgence there, it's definitely more worrying for margins. But I think the productivity gains that you're seeing mean that you can actually have margin expansion, or at the very least, you can stay at these very high levels that were the top of the previous range before COVID.
One company doesn't make a trend, but I do wonder what signal you get from the likes of Macy's that comes out and it really talks about pretty significant declines in same-store sales in their namesake brand. It basically highlights the difficulties that certain lower-income consumers are having continuing to maintain their spending. How do you factor that into an outlook at a time where a lot of people are kind of looking past that?
Yeah, I mean, I think it's something to consider, but I think from the high level earnings that we're seeing, consumption is still strong. Something that's also been talked about is this kind of zero interest rate lending that's been happening. So low end consumers are able to soothe their consumption more because they're getting these zero interest rate lending. And so I think that's also propping up the consumer. But I think you need to look at the aggregate numbers in terms of where is the level of net wealth? How is the economy doing generally? And we have come down significantly, which is what you're pointing to, but coming down significantly from a very high level in savings to a still high level is still positive for overall consumption. But it's certainly worth watching the kind of lower end of the consumption range because that is the marginal consumer. It is the marginal difference that makes, the overall growth result.
Skylar, you mentioned disruptions coming from the Red Sea. The British Chamber of Commerce says it is hitting their exports. What does it mean for American businesses and manufacturers?
When we think about the Red Sea, we think about it from an inflation perspective because it is a shipping cost that feeds into your overall inflation number. The reason we're not worried about it significantly right now is that U.S. goods, only a small amount of that cost is shipping costs, and only a small amount of those shipping goods, or those goods generally that the shipping cost is feeding into, goes into the overall inflation metric. It's also a very different environment from when we had supply disruptions in 2021. We don't have these massive imbalances in supply and demand for goods. We don't have this, backed up shortage, and so it's not as worrying as it was back then, and it is a smaller part of inflation as well.
Thank goodness. Skylar, thank you. Good to catch up as always. Can you imagine, Lisa, if we did have those kind of dynamics back from 2020, 2021, and we had this tension in the Red Sea, these issues in the Panama Canal?
I mean, basically, this is a reason why so many people have been surprised, and it's been the Widowmaker trade to try to bet on energy. And a lot of people have done that again and again because of how different and how quickly it has really changed.
And with the Red Sea, though, it's always about that goods inflation. It's going to impact Europe much more than America. But we're talking about what's going on in Macy's. And what does this mean for the lower end consumer? If you have more disruptions, even in energy or goods, it's going to hit the lower end consumer.
Can we talk about consumer confidence a little bit as well? 10 a.m. Eastern time, I think the Conference Board releases consumer confidence. Unemployment's been south of 4% for 24 months, 2 years. So unemployment rock bottom, equity markets all-time highs, financial conditions based on what's happening with corporate credit markets seem to be sort of wide open to issue debt at the moment. Are we expecting consumer confidence to keep rebounding this year?
Yes, except that it's the current condition that people feel is positive, but their expectations for the future and for everybody else tends to be negative. That's where we're at right now.
And that's highly dependent on your politics.
Exactly. Look, people have seen this upward trend. How long it can continue is hinged to the price of gasoline, is hinged to the news cycle. People will blame us. It's sort of these put on repeat.
Retail sales were softer, and then we had that spike in inflation that no one was expecting. Will that impact the Conference Board? Because we had 3 months of a higher trend. The White House loves when the Conference Board comes out, and it's a good note, especially also as well as the Michigan University. If that was starting to sour, that's going to upend some of their messaging.
Yeah, the second piece of that's important. They love it if it's good. If it's good. If it's not, probably won't be talked about. We'll find out if it's good at 10 a.m. Eastern time. Equities right now on the S&P positive by 0.1%. Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The global economy has a growing chance of pulling off a soft landing, according to a draft seen by Bloomberg of the G20's closing statement at this week's meeting in Brazil. While the text isn't final, The draft says, quote, risks to the global economic outlook are more balanced. Upside risks include faster than expected disinflation. Global finance ministers are expected to arrive for meetings in Sao Paulo tomorrow. Shares of Lowe's are falling despite the company's reported fourth quarter comparable sales that beat analyst estimates. It was still a decrease, with the home improvement retailer citing a slowdown in DIY demand and unfavorable January weather. Despite that, the company's CEO says, quote, we remain confident in the long-term strength of the home improvement market. Expedia cutting about 9% of its workforce as the online travel company attempts to revive growth and regain market share. The Seattle-based firm will cut about 1,500 jobs across the globe. Some employees affected will be notified on Monday. Earlier this month, Expedia reported disappointing holiday results and issued a weaker-than-expected outlook for the current quarter. It also announced a leadership shakeup. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, hope increasing for a ceasefire in Gaza.
My national security advisor tells me that we're close. We're close. It's not done yet. And my hope is by next Monday, we'll have a ceasefire.
That is coming up next. Live from New York, this is Bloomberg. Stocks are positive by 0.1% on the S&P 500, drifting just a little bit higher, drifting lower. 10-year yields down a basis point, 426.58. A little bit later on today, this afternoon, $42 billion of 7-year notes coming to market. Look out for that auction a little bit later. Under surveillance this morning, hope increasing for a ceasefire in Gaza.
Can you give us a sense of when you think that ceasefire will start, sir?
Well, I hope by the beginning of the weekend. The end of the weekend. At least my national security advisor tells me that we're close. We're close. It's not done yet. And my hope is by next Monday, we'll have a ceasefire.
Here's the latest. The president expressing optimism for a temporary pause in fighting in Gaza while enjoying an ice cream on a visit to New York City. Israel and Hamas yet to comment on Biden's remarks, with Israeli officials continuing to say a ground offensive in Rafah is coming. Aaron David Miller, senior fellow at the Carnegie Endowment for International Peace, joins us now for more. Aaron, can we just start with the comments we've heard, not from President Biden, but from the Israeli leader, Benjamin Netanyahu, who said that Hamas continues to make what he calls delusional demands. Do we know what those demands are?
I think earlier in the negotiations, the reason they've stalled is that Hamas was asking for 1,500, even more, Palestinian prisoners accused, some convicted of serious security offenses, specifically killing Israelis. But I think, frankly, one of the reasons we're closer to a deal is that Hamas seems to have walked back some of those demands. You're not talking about, still it'll be an asymmetrical trade, 45 hostages or so for 45 days of quiet, and probably hundreds of Palestinian prisoners. But in terms of the hardcore prisoners, probably many fewer than Hamas wanted.
Biden's talking about potentially this can happen as soon as Monday. And then on Sunday, March 10th, is the start of Ramadan. Does a deal have to get done between Monday and Sunday for this to be successful?
You know, I have to tell you, I was kind of surprised the president is putting a specific date on these things. I mean, one of the worst offenses you can commit in negotiation is to signal that you're in a hurry, a real hurry. But I think here you really do have a situation where there's real urgency on the part of Hamas and perhaps the government of Israel to take advantage of the fact, military pressure, Hamas's decision, they have to pay attention to their constituencies in Gaza, even though they've wreaked havoc on them as a consequence of this terror surge on October 7th. But a Ramadan pause will play to their advantage. One more point. I think the Israelis, frankly, may well be getting much closer to identifying where Yahya Sinwar and the other three architects and implementers of this October 7th terror surge are, ensconced below ground in Rafah, perhaps, or Khan Yunis. And that poses a fascinating and cruel dilemma. What if the Israelis actually identified where Yahya Sinwar was in the next few days? Would they strike to kill him, which could jeopardize the looming and pending hostage exchange? I think the answer is they probably would.
David, I just want to pick up on your first point that you're surprised the president is putting a specific date on this. Does that have more to do with what's going on in Israel, or the fact that a large number of what we're expecting Arab Americans in Michigan today are going to vote uncommitted on their primary ballots?
Yeah, I mean, I think, look, domestic worked for Republican and Democratic secretaries of state and presidents. Politics hovers over all of them, Michigan in particular. But frankly, I'm not sure a hostage exchange is going to fundamentally alter the position of those Michigan voters who hold the president responsible for his preternatural support of Israel and the deaths of Israel's efforts to identify and crush Hamas's military organization, result in the deaths of thousands of Palestinians. I'm not sure this particular deal is going to change their mind. What might begin to alter it if you change the pictures in Gaza. And maybe this deal will allow 45 days or so to do that. But we are by no means at the end of this war.
Aaron, you talked about pressure on Hamas building. Pressure from who?
The IDF. I think the Israelis are operating now in Khan Yunis. They've been operating there for weeks. And I think they have made significant progress in terms of eliminating the majority of Hamas's battalions. But the senior leadership, Yahya Sinwar, Mohammed Deif, Marwan Issa, Mohammed Sinwar, those who actually planned October 7, that's who the Israelis want to get. And I suspect whether or not this deal goes through, and even if it does, the Israelis are going to be in Gaza for as long as it takes to eliminate Hamas's senior leadership. For Mr. Netanyahu, frankly, that will be the most visible material gain of a 5-month war so far. And for political and legal reasons, in order to stay in power, Benjamin Netanyahu needs some sort of victory in this war.
The reason why I ask, Aaron, is because we aren't hearing a lot about Iran, and there are real questions about the appetite to continue this, especially given some of the ratcheting up in tensions. I'm interested in what's going on with Saudi Arabia, in Qatar, what's going on with respect to Hezbollah and the simmering tensions that have become tit for tat on the northern border. Is there a sense that Iran is also pressuring Hamas to come to some sort of deal to de-escalate what's going on in the Middle East?
You know, the Iranians are pressuring their pro-Iranian groups in Syria and Iraq. I'm not sure, frankly, right now. Iran, according to the best intelligence estimates, was surprised by the October 7 attack. I'm not sure the Iranians right now are the key drivers in Hamas's calculations. I think political and physical survival is what's motivating Hamas. And I think Sinwar actually believes that he will survive this, and Hamas will continue to exercise a fair amount of influence, perhaps even control in Gaza in the months and years to come. I think that's what's driving this trend, not to minimize the importance of Iran as a factor in regional destabilization.
Fascinating. Aaron, always appreciate your opinion, sir. Thanks for being with us. Aaron David Miller there of the Carnegie Endowment for International Peace. That's one war. Here's another. Just getting some comments from Janet Yellen, the Treasury Secretary, meeting with the G20 finance ministers down in Sao Paulo, Brazil. You'll all remember that 2 years ago, the EU, G7 nations and Australia froze about $282 billion worth of Russian assets, much of that in the EU, more than 2/3 of that, much of that in France, in Belgium. This is what Secretary Yellen's got to say this morning in prepared remarks. I believe there is a strong international law, economic and moral case for moving forward and using this phrase, Annmarie, unlocking the value of those assets to bolster Ukraine's defense against Russia.
Yeah, there's been a lot of debate about this, what kind of precedent this would set in terms of these assets that are frozen, but what happens in terms of their value? Do you give that value to Ukraine? There was some talk potentially of the interest that some of these assets are accruing. Maybe the interest goes to Ukraine. Actually, two things. One, this is going to be a huge cloud over this G20 because you have countries who do not agree with this statement the Secretary is putting out there. And there's been a lot of divergence between the global South and the West. And then second, kick this down the road. There's going to be nothing that happens in terms of our reporting until the G7 meets. The United States is going to want to act with Europe when it comes to these assets, but it's going to be highly controversial.
Unlock the value. What does that mean? It means take the money, right? It's basically you have assets that you have frozen, that you are holding custody from Russia, and now you take those assets and you use them to give them to Ukraine. Some people would say this is actually a great way to pay for the offensive by Ukraine. But to Anne-Marie's point, it raises questions. Well, what kind of risk, if people are trying to decide whether to put their money with you and you're going to be the custodian, what kind of reputational risk is that going to create?
Long-term reputational risk is what a lot of people are concerned about, and the weaponization, what they call, of the U.S. dollar. And we spoke to Wally Adeyemo last week about this, the Deputy Treasury Secretary. And he basically said TBD, but leaning in on they would like to see something happen. I think Janet Yellen using the word moral is very interesting here.
This is perhaps easier for the United States to take a stance on because this money, these assets are in European nations.
Mostly Brussels, yeah.
Predominantly Belgium and France as well. They are not in direct conflict with Russia right now. That's why legally this gets interesting, and certainly I'm not a lawyer and I won't comment on that from a legal perspective, but certainly that's why it's murky. I'll also say this, there's a second quote in this statement. Is this really about unlocking value, or is this about a negotiation tactic? This would be a decisive response to Russia's unprecedented threat to global stability. It would make clear that Russia cannot win by prolonging the war and would incentivize it to come to the table to negotiate a just peace with Ukraine. The latest from the Treasury Secretary this morning in Sao Paulo, Brazil. Coming up on this programme, Macy's reporting better than estimated fourth quarter results, but announcing plans to close 150 stores. We'll catch up with the CEO of Tanger up next. Live from New York, equities doing okay, positive by 0.1% on the S&P 500. Here's a snapshot of things in the equity market on the Nasdaq, positive by 0.3%. Small caps doing all right. Russell's up by about 0.6%. Yesterday, big test for the bond market. Lots of debt came to market. Through the front end into the belly of the curve. Today, the 7-year note, $42 billion worth. Going into that, yields a little bit lower at the front end. We back away from 470 on a 2-year lease of 468.50 on a 10-year down a basis point, 426.78.
There was just on the margins a sense yesterday at the auctions that people are pushing back a little bit. 7-year might be more interesting, especially because there is this concern about the debt, about this government shutdown, or technically there should be, or some people would argue that there is, but that never seems to show up when
I can tell you, though, it gets pretty interesting outside of the auctions. There's a big debate right now in fixed income on the south side as to where we go next from here. Barclays put this out. What reason is there for sell-off from here to stop? And this is what we heard from Goldman. There is limited room to price out further cuts from current levels. So two very, very different views there on where they think yields are going in treasuries.
There are also completely different views about whether we actually have restrictive rates right now. Because right now you're seeing pretty great growth and you're seeing inflation that surprised to the upside in 2 different readings last week. So if you put that together, it does raise this question of how high rates can go and longer term, what the base inflation is going to be at a time when a lot of people are saying we're in a new era.
I won't bore you with the euro. I'll excite you with the yen. Dollar yen looks like this in the FX market. 150.26. We've got a move here. 0.3%. Stronger Japanese yen. Inflation comes in, Bramo, and people are asking the question, is it time to go at the BOJ? And not cut, that's the Federal Reserve conversation, that's the ECB conversation. They never started hiking. Are they going to hike?
Okay, are they going to actually have a positive overnight benchmark rate? And now the market's pricing in about an 80% chance by April, up considerably because inflation is coming in at 2% versus 1.9% expected.
It's been a long, long time. Dollar yen, 150.25. I'll go through some numbers on that currency pair for you a little bit later. Kit Jukes was talking about what happened in the 1990s, how you can get to 160 and how quickly you can get back down towards 100. Under surveillance this morning, here are your top stories. President Biden meeting with congressional leaders later this morning, looking to strike a deal to avoid a government shutdown and unlock billions of dollars of emergency aid. Speaker Mike Johnson, Senate Majority Leader Chuck Schumer and Minority Leader Mitch McConnell among those in attendance, with the deadline for some government agencies coming as soon as Saturday, with the remainder of the government facing a March 8 deadline. I asked this question in the previous hour, Anne-Marie. Can we avoid a government shutdown, and can that man keep his job?
Well, one, potentially might stumble into a government shutdown. This is how Libby Cantrell of PIMCO is explaining it, because it's in 2 tranches. There's March 1st and March 8th. March 1st is important, Friday at midnight. Potentially these 4 agencies are going to run out of money, but the big one would be March 8th. But I would argue ignore these dates and look at April 30th, because regardless of what happens, there will be a 1% cut across the board based off the McCarthy-Biden deal. The question on whether or not he keeps the gavel, will this caucus show a little bit more grace to him, because there was a lot of acrimony between some members with Speaker McCarthy? It's a great question. Once he does a deal with Democrats, that question will become front and center. Is his job at risk?
That meeting, 11:30, a little bit later this morning in Washington. I want to do a check of shares of Alphabet this morning as well, rebounding in the pre-market after falling yesterday by more than 4%, on concerns over its AI offerings and the risk that AI-powered competition poses to its search engine, Google. The stock's shedding more than $70 billion in value, with concerns growing after Google paused its AI image generation feature after drawing criticism over inaccurate historical depictions of race. We've asked this question already this morning. Bramo, ultimately, have they put ideology before facts? And if they have, how much confidence will be lost in this business?
Which is the reason why shares were down, I think, something like 4.5% yesterday. But it raises a bigger question, and I keep going back to this. What kind of biases are getting baked into some of the generative AI models that we haven't had time to really identify? And it's going to be the subject of a lot of scrutiny, especially given the court case at the Supreme Court right now that they're dealing with respect to mediation or moderation of some of these platforms. This is a huge issue, and it's not very clear.
Well, here's the tricky question. Who can we trust to regulate it? If this is about ideology versus facts, who on earth can we trust to regulate this kind of thing as it's sort of unveiled?
You raise a great point, and this is the reason why some people would argue, okay, it's messy, but in the United States, you put it out there, and at least it fosters innovation for people to try things. And ultimately, the real check might be the consumer, right, in terms of where they trust and where they go.
Nate Silver, though, I think nailed it. Why would they release this if it wasn't ready for prime time? One Google executive writing in a post said, quote, some of the images generated are inaccurate or even offensive. You're Google. Why would you put out anything that is, quote, inaccurate or offensive?
I'll tell you, the ultimate concern is they thought it worked. In-house, they tested it, and this was the desired outcome. That would be very, very concerning. I want to turn to this story as well. The FTC, 8 states and Washington, D.C., are suing to block Kroger's $24.6 billion acquisition of Albertsons, arguing a merger of America's biggest supermarket chains would lead to lower wages and higher food prices. A deal would be the biggest U.S. grocery deal ever, with the company saying the merger is needed to better compete with Amazon and Walmart. They make a pretty decent argument, Bramo. Whether it's good enough, I'm not sure what a good argument is worth in Washington on this front.
How big is too big to consolidate? That's really the ultimate question that everybody's looking for. There are a lot of questions around this FTC and how closely it ties to previous FTCs and the different thresholds they had.
Big morning for the consumer in the spotlight. The Conference Board's latest confidence survey due out at 10 a.m. Eastern Time. This is retail giant Macy's reports fourth quarter earnings that beat estimates, but 2024 guidance fell short. The company also announcing plans to close 150 underperforming locations in an effort to ward off activist investors. The CEO calling 2024 a, quote, year of transition and investment. Stephen Yalof, the president and CEO of Tanger, a leading operator of open-air shopping centres across 20 US states and Canada, joins us now to discuss this sector and your business, sir. Stephen, good to catch up with you.
Thank you, John.
Thanks for being with us. Let's get into this. Traditionally, we talk about a Macy's and a Bloomingdale's being that anchor retailer in a mall. How has that changed and how have things developed for you?
You know, the footprints of our shopping centers are considerably smaller than the larger regional malls. So for us, anchor retailers are in the 25,000 to 35,000 square foot range. So far less reliant on any one tenant in any of our shopping centers, but they're still great draws. So, you know, Bloomingdale's still has an outlet business, Saks off Fifth too, both of which they facilitate brands that you wouldn't get in typical lifestyle stores that you have in our shopping.
So much has been written about this sector, this industry in the last 10 years, and usually it goes something like this: malls, dreadful, dying, it's the end. It's not for you, is it? You see things quite differently.
Well, first of all, you know, ever since COVID, the open air shopping center has really been sort of the highlight in our sector. People like the place where they can gather, where it becomes a community space. So the outlet centers of 10, 15 years ago, really power shopping experiences, but now they're evolving. We're changing the uses. We're filling some of that vacancy that was created by COVID with different types of uses, not necessarily outlet uses. Bigger draws, draw retailers where people want to come and shop every week as opposed to once a quarter.
How much are you seeing that bifurcation that we were talking about in Macy's with respect to some of the lower income shoppers or people who are more looking for discounts and those who are willing to go to the upper end types of products?
Well, you know, look, we see Macy's as a competitor for us because Macy's is branded value. And that's pretty much what we're selling all day. So for us, if we can create more theater, if we can create more excitement, if we can create more of an entertaining environment for people to shop, and I think they find that when they come into one of our centers where a Ralph Lauren store is end-to-end just Ralph Lauren. So you can shop the entire lifestyle, the brand, the depth, the breadth of the product in one environment where the service, and that's a huge part of the business too, is, you know, it's interesting, you know, all the different places where one can shop online or large department stores. I think there's nothing more satisfying to a customer that when a service representative says, you know, you look pretty good in that thing. And that sometimes helps close the deal. So, we want to make sure that we provide service where a lot of those other venues don't.
I need someone to tell me that I look good before I buy something. No, look, there's a real question here, and I guess I'm going to the question of the consumer and the retailer and the ability to spend right now. There's so many sort of broader economic questions tied to your business to understand how many people are willing to shell out $100, $200 a day for the experience, for the walking up and down the mall and buying some food in the process. Are you seeing greater foot traffic increasing, or do you see a real kind of pushback, restraint by consumers that have gotten stretched?
So our traffic numbers seem to be pretty consistent with where they were, even in the peak. Prior to 2019, we're seeing more cars now in our center than we did then. And I think a lot of that is because we're closer into where the public is shopping now. The old narrative on outlet centers, we were so far out that it required a special trip and a special drive. And now what we're finding is people are moving to a lot of the geographies where our centers are. And we become the center of the energy. And because of that, in order for us to compete in those marketplaces, we need more variety. And variety comes not only with better outlet retailers, but it also comes with better food and beverage, restaurants, sit down, entertainment, things for people to do. And that's why we're seeing the cars come. And they're coming more frequently.
When I grew up, going to Tanger was a highlight, twice a year. Now it sounds like what you're saying is you're making this habitual. How do you do that? How do you see returning customers so that it's not just, I'm going to go to the outlets once a year?
Well, let's take Deer Park, which is out in Long Island, which might be a shopping center that you visited. So you take a look at a center. Well, you take a look at a center like that. So it's up to us in order to make sure that we continue to drive customers into the center far more frequently than they had in the past. It's just the variety of uses that we bring and the brands that people like. The customer is evolving; they're getting younger. And, it's really a lot of competition to get people off the couch and into a shopping center. So you can't just use great creative marketing to get a younger customer to come to your centers. You have to have the brands that they like. So a lot of these new, cool, direct-to-consumer brands you only saw online, but now you're seeing these brands in a bricks and mortar format. We're getting them into our centers, and they're serving as a big part of that draw.
You said that rent in an open-air outlet is less expensive than in a mall. Why is that?
Well, open air, first of all, the common area maintenance piece is a considerable charge to a lot of retailers. It can pass through to retailers, quite frankly. And in our centers, when you're open air, there's far less of that expense to divide amongst the retailers. Especially in our shopping centers, we're primarily southern-based. So, snow removal is a huge part of the narrative, too, especially now. Actually, we just bought a shopping center in Alabama, and within the first month that we had that center, it snowed in Alabama.
Wow.
Believe it or not. So there's an expense piece of that we at least see some savings on that.
Can we talk about crime in retail as well? If we had some politicians here, depending on their party, they'd tell you it was really bad or there was nothing to see here. What's the reality in your business, and is it regional? Is it state by state?
I think it is state by state, and look, it's a problem everywhere, and it's something that we are absolutely rigorous that when we dive in, and technology has really played a great role in helping us think through that. How do you thwart off potential organized crime? We have great connectivity back to the FBI and other great government agencies that give us alerts when there are some things that are planned. And, we have great surveillance on site, digital surveillance, drone surveillance, so that if an incident does occur, we've got great opportunity to do that.
Do you find the pressure, though, the burden has landed on you to spend more on security? Has this been passed to you?
Well, we're partners with the retailers in our centers, and a lot of those retailers contribute to, we talked about CAM earlier, and they can contribute to that CAM cost. But, look, when something happens at a Tanger center, it's Tanger that's on that masthead. And sure, it's a big part of our responsibility. We'd like to say that we provide a fun, entertaining, and safe environment for our shoppers to come every day. And we'd love to be able to, that should be our hallmark as we go forward.
Stephen, you're going to stick with us, I'm pleased to say. Just need to get you an update on stories elsewhere. We can do that with your Bloomberg Brief and catch up with Danny Berger. Hey, Danny.
Hey, John. This is your Bloomberg Brief. President Biden defended his mental fitness and took a jab at former President Donald Trump in an appearance on Late Night with Seth Meyers.
Number one, you got to take a look at the other guy. He's about as old as I am, but he can't remember his wife's name.
Yeah.
And number one. Number two, it's about how old your ideas are.
Biden has struggled to relieve Americans' fears that he is unfit for a second term. A January NBC News poll showed that 3/4 of voters, including half of Democrats, say they have concerns about Biden's age. Less than half have the same concerns about Trump. Fast fashion company Shein may move its IPO to London from New York because of regulatory hurdles. Sources tell Bloomberg that Shein believes the SEC is unlikely to approve a public offering because of its operations in China. The company is still working on an application to list in the U.S., but could also consider Hong Kong or Singapore. Shein filed for an IPO in the U.S. last year with a valuation between $80 and $90 billion. Chocolate lovers could be in for a price shock with the cost of cocoa at all-time highs. Declining production in West Africa and an upcoming new EU deforestation regulation have contributed to the price jumping more than 50% this year. The new regulation will require chocolate makers to prove that every bean they import to Europe didn't contribute to deforestation elsewhere. A costly exercise that threatens to drive prices even higher. And that's your brief. John.
Danny, thank you. They're coming after your chocolate now. Up next on this programme, I'm joking. I'm joking. Up next, markets digesting more Fed speak.
We're at the end of the cycle, and the market is not going to challenge the Fed like they did last year. August, September of last year, we saw the sell-off. This is a very different time frame.
Was I, though? Live from New York, this is Bloomberg.
Absolutely not.
Live from New York, stocks doing okay. Session highs up 0.2% on the S&P 500. Bond yields down a basis point on a 10-year, 426.58. Under surveillance this morning. Markets digesting more Fed speak.
We're at the end of the cycle, and the market is not going to challenge the Fed like they did last year. August, September of last year, we saw the sell-off. 10-year yields rose dramatically in a very short amount of time. This is a very different time frame. The Fed is telling us that they're going to cut rates 3 times, and the market's not willing to challenge the Fed.
Here's the latest. Kansas City Fed President Jeffrey Schmidt urging patience in his first major speech since taking the job, saying, quote, with inflation running above target, labour markets tight, and demand showing considerable momentum, my own view is that there is no need to preemptively adjust the stance of policy. Guy Labat of Janney Montgomery Scott writing, quote, not much has changed in the Fed outlook over the last few weeks, so it's time to exercise some patience. Fed pricing is finally close to our expectations, 3 cuts in 2024, starting mid-year. Guy Labat, pleased to say, joins us right now. Guy, it's amazing. This corporate debt supply, records, January, February, credit spreads, multi-year tights, and it's happening even as we price out rate cuts from the Federal Reserve. Guy, if you'd asked me, this is probably a lesson for people. Don't ask me. I would have said this is not how things would work out. Guy, did you anticipate this?
Well, the Fed pricing, yes. The corporate supply and the decline, the narrowing of spreads year to date, certainly not. Right now, investment grade spreads are in the bottom 7th percentile of all history. What we tend to see for credit spreads is they go through these periods and sort of like regimes of really, really tight spreads. A great example is the late 1990s, and there's also some echoes of monetary policy around that period, but spreads were below their long run average for something like 3 years in that period. And I'm not confident that we're going to head that way this time around, but there is a little bit of evidence, at least in the liquidity and the inflows to the investment grade markets right now.
Well, Begid, is there sort of a threshold at which if benchmark rates remain, say, at 5.5% for the rest of this year, that would crack some of the demand for corporates that seems to be uncrackable right now?
Well, I think there's a lot of inflows in particular coming from the pension allocation community. So public pensions in particular tend to be slow-moving entities. These are state and local government pensions. They're the group that we deal with a fair amount here at Janney. And what we've seen is that through much of the last decade and a half, in order to repair some of the underfunding over prior years, they've been more heavily overweight risk assets. Well, now that cash flows from fixed income investment grade credit are sufficient enough to drive their own long-run returns, they're allocating increasingly to the credit side of things. And I think that's driving a huge and underappreciated amount of demand. And that demand only goes up as rates move higher.
So this raises this question about what the consequences are if rates do remain higher. PIMCO's Tiffany Wilding was pointing to a host of reasons why inflation is going to be stickier, in particular in the housing market, than some people believe, writing last week that the Fed faces that last mile problem. The relatively painless disinflation of 2023 is likely to become a slower, more nuanced process in 2024. The big risk here is a delay to the start of cuts or even just a much slower process than market's expecting. What's the consequence of that, Guy? Is that fully priced in a market that currently has gotten on board with the Fed's projection of 3 rate cuts this year?
Well, essentially, what I view the market pricing from a macroeconomic perspective is the same mid-course correction that occurred twice during the Greenspan Fed and has been absent for a number of years since. Essentially, a reduction in interest rates in a period in which growth is not slowing very, very rapidly. And pretty much each of those cuts, the series of cuts, have been about 75 basis points. In fact, just last week, Philip Jefferson, the Fed's vice chair, highlighted several of those episodes in his first major speech in some months. But I think it's indicative of what the markets are pricing right now of a period of economic growth that sustains for a lot longer than maybe we or many others would have thought 12 or 18 months ago.
It's been phenomenal. Guy, it's great to get your view on things, as always. Guy Labar of Janet Montgomery Scott. Just think about it. Rates have gone above where people thought rates would be. They stopped at 5.5%. They've stayed there longer than people thought they would. And yet still, unemployment is south of 4%. Equity markets are at all-time highs, and we're talking about record debt issuance, Lisa, taken down really quite nicely by the market over the last 2 months.
So does this mean the long and variable lags weren't in existence? I mean, this is really the question.
Long.
Or they're super long, right? This is sort of the big question, right? Is it just people who have mortgages that are 3% that are locked in that aren't going to be buying anything and they're not going to be affected by some of the rate hikes? Or is it something that is a more sustainable strength in the overall economy?
You know, there was a meeg for smug, sort of a meme for smug. It was like that right there as I was looking at you. That 3% mortgage. Stephen Yellows with us from Tanger. Great to catch up with you, Stephen. Let's talk about rates. Multi-decade highs. Can you walk us through how this has shaped your business in any way, shape or form?
Well, for us, you know, being on sale every day, and I think that's a big part of the narrative for us. You know, it's like the consumer we were talking about trading down, the consumer that rather than spending their dollars on luxury products are really looking for branded value. There's been articles written recently about even the highest end consumer shopping in stores where they were able to get the same products that they're looking for, but get them at the best possible price. And I think that's what we do every day. So we're seeing a lot of customers that we hadn't seen in the past coming in, at least investigating and looking at our product. And I think we're converting a lot of customers that way.
It raises a question also just about your real estate portfolio, because ultimately you do manage a whole host of different properties and you own them. And I'm wondering whether it's a time to be buying if you have all cash and you can buy, because people who do want to get out might have a more limited slew of potential buyers. Or is this sort of a place where you need to sort of manage a little bit more carefully?
Yeah, well, last quarter we brought 3 new properties to market. So, for example, we built a brand new center in Nashville, Tennessee, opened in October. And then we purchased 2 properties, one in Asheville, North Carolina, and then one in Huntsville, Alabama. Huntsville, Alabama being a lifestyle center, not an outlet center. So it's the first in our portfolio that is not outlet or off-price focused. And we think that makes a tremendous amount of sense because of the team that we built and the platform that we built, focused on leasing operations and marketing. We think that team can execute to outlet specific and then adjacent to outlet, which we think is what lifestyle fills.
Do you think it's a particularly good time to expand and be buying properties because of the discounts due to where rates are?
Yeah, well, for us, look, we have great access to capital. We've untapped lines of credit. We've got a relatively low debt-to-EBITDA ratio. So our balance sheet is very solid, and we are definitely in growth and acquisition mode right now.
More acquisitions. Where would you make them and what would they look like?
You know, we like the South. You know, we've been very successful in the South. Open-air shopping centers are, you know, the hours of operation and the months of operation are definitely extended.
That's a weather trade for you.
100%.
Well, you know, it works for us for sure. You know, look, we're a southern-based company. We're based in Greensboro, North Carolina. So we've grown up in that marketplace, so we know it pretty well. And like I said, our last 2 acquisitions were, well, we built in Nashville, but we acquired in North Carolina and Alabama.
We hear from certain industries it's easier to do business in certain states than others. Would you say the same thing?
Definitely. You know, and I think it's more the community than the state. You know, when we build a new shopping center or when we come into a new marketplace, it's really that community. It's the local government that needs to be pro-business or not pro-business. And when they are pro-business, it really works out great. First of all, if you think about it, any one of our shopping centers employs 1,000 people, and where do they come from? They come from that local community. So we're additive from a job network and job creation point of view, but also we're a big tax generator for a lot of those.
It's refreshing to hear you say it's about the weather. When I first moved over here, I thought old people went to Florida because the weather was nice. I didn't realise it was about the taxes.
Yeah.
Took me a while to catch on. Took me a while.
Well, look at Jeff Bezos.
Yeah,
Washington to Florida.
Without a doubt, that's about the taxes.
Yeah, but open-air shopping centers is about the weather.
It's about the weather,
yeah,
of course it is.
I mean, honestly, in New York City, can you imagine? It's like a complete snowstorm or it's raining torrentially.
It'd sell a lot of Canada Goose, wouldn't it?
I'm sure, something
Canada
like that.
Goose. Stephen, thank you. Stephen Yaloff, appreciate it, sir. CEO of Tanger. This is bad humour today. Really bad.
That was really bad.
In the next hour, Victoria Fernandez of Crossmark, Henrietta Trays of Vader Partners, Dana Peterson of the Conference Board, Joe Feldman of Telsey Advisory from New York City this morning. Good morning. Equities positive. Session highs up by 0.2%.
It's very much a sort of late 90s type market.
Macroeconomic data is not being considered as seriously as the likes of Nvidia results, which to me is bonkers.
At least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks.
The longer the Fed keeps rates higher, the higher the odds that we see a meaningful slowdown in growth.
The Fed is in no rush to remove the policy firming that they've put in place over the past 2 years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. 90 minutes away from your opening bow. That cash open just around the corner with equity futures near session highs up by close to 0.2% higher on the S&P 500. And Lisa, 30 minutes away from some data in America.
Yeah, durable goods orders in particular, as well as capital goods orders. Basically, how much are companies ordering? And I'm sure we'll be talking about Boeing because a good portion of those durable goods are airplanes. So we'll find out about that. But under the hood, how much confidence do companies really have to keep spending in a material way at a time where maybe we're starting to see a troughing out of some of the goods sectors that really did see something of a recession?
Well, speaking of that word, confidence, consumer confidence comes 1 hour, 30 minutes after that data drops in half an hour's time. And when you look at consumer confidence, you'd be thinking there's plenty of reasons to be confident. Equity markets are at all-time highs. If the consumer cares a lot about credit, you should, by the way, credit spreads are at multi-year tights. And off the back of that, look at the data itself. The labour market, unemployment south of 4% for 2 years. It has plagued this administration, this White House now for much of the last 12 months. Why isn't that translating into higher consumer confidence? It started. Will it continue?
Well, that's the question. It's starting, and you can see from whether it's Lael Brainerd or Janet Yellen, the Treasury Secretary, they want to talk about the Michigan survey. They want to talk about the prior 3 months we've gotten from the Conference Board in how Americans are feeling about their economic conditions. And then, Lisa, you mentioned it earlier, their outlook for the next 6 months. That is key, the outlook for the next 6 months. And you have to ask, was January, some of that poor data, softer data, or higher inflation, is that going to impact what we see today from this survey? And then the question is going to be for the Biden administration, how do they turn that message around?
Not to sort of stretch this too far, but sort of wedged in between the consumer confidence, the durable goods, we get house prices. And how much is that part of the story? Right, the fact that you cannot have the same kind of life if you're younger or if you don't have a mortgage rate of 3% to try to buy something. And then, how much
You
can
just
you
always
wash?
want to rub it in, right? Annmarie, you're never going to get a 3% mortgage rate. Thanks, Lisa.
Framing that smugness again.
No, but seriously. No, in all seriousness, though, that really does feature into your sense of confidence, your sense of stability.
If you'd like, I can just clip this and just repeat it.
It's like having dinner with my parents now. Breakfast with you. It's like you're never going to get on the property ladder.
Let me tell you about that 3% mortgage that I had all those years ago. Let me tell you about Treasury Secretary Janet Yellen. She made some comments this morning in a press conference in Sao Paulo, Brazil, at the meeting of G20 finance ministers. The outlook for the global economy, quote, quite favourable on inflation. It will move closer to 2%, Lisa, as the year goes on.
This has been basically what she's been saying for a while. This is the disinflation that people have been banking on. This was consensus about 3 weeks ago, which feels like a year ago. But now people seem to be maybe questioning that. We heard that from Jim Bianco yesterday. Maybe we're seeing a troughing out of inflation around 3%. And then, just a persistence of that. If it is hard to get that last mile, can the Fed still cut rates? Can you get this sort of sense that rates are going much lower? Or is this a new paradigm that we haven't been familiar with for a while?
We've got some more time if you want to pick up your single again and tell everyone about your mortgage. One more time. Just rub it in, Bram.
I will say, not everybody is in the position to have a 3% mortgage, and that is going to affect housing prices, and it's also going to affect, or actually, it hasn't affected housing prices.
Yeah.
That's sort of the shocking aspect of it, and that's why so many people are getting locked out of the housing market.
Thanks for thinking of us. We appreciate it. In the equity market right now on the S&P 500, positive here by 0.1% on the S&P. There's a little bit of a lift going into this economic data, 25 minutes away. Yields are lower by a single basis point on a 10-year, 4.2658. Coming up this hour, Crossmark's Victoria Fernandez on why she's trimming tech. Henrietta Trays of Vader Partners expecting a partial government shutdown Friday. And Dana Peterson at the Conference Board looking ahead to inflation data and a little chat, I'm sure, about consumer confidence too. We begin with our top story. Stocks lower after last week's record rally on the back of Nvidia earnings. Crossmark's Victoria Fernandez saying, now is the time to be selective. She writes this: we want to stay invested, but would begin to trim some of those tech names and find favourable areas to invest like healthcare or financials. The entire market will be dragged down when the economy stumbles, but you can be opportunistic in the meantime. Victoria joins us now for more. Victoria, I've got to talk to you about the career risk associated with trimming some of these names and going elsewhere. How big is that? Does that loom large for you?
Look, we've been on an island for a while, Jonathan, at Crossmark. I mean, we talked about the market was ahead of itself in regards to how many rate cuts there were going to be. It was ahead of themselves in front of timing. So we don't mind being out kind of by ourselves a little bit here. But when you have longer term investors, which is what our clients are, you want to have exposure to these names. We do. But when you have the run-ups like you have had, I mean, look, Nvidia had great earnings, right? We knew they were going to have strong earnings. So when you have a run-up like what you've seen in that stock and other AI related stocks, it makes sense that you should go in and trim a little bit of that. Take some off the table. We're not saying liquidate your holdings. Obviously, you want to have that exposure. But we do think this momentum that we're seeing in the market is going to go on for a little bit longer. But all of those red flags we've been talking about for the last 6-9 months, we do think are going to kind of raise their head again around the middle of the year when the Fed starts to lower rates. And that way you can be better positioned if you've taken a little bit off the table and put it in some of the other areas that we think are going to start to show leadership.
When you joined us more than a month ago, you said this equity market was priced for perfection. This month alone, we're up something like 5% on the S&P. What are we priced for now?
Yeah, it's a good question. I mean, you look at the valuation of this market, look at the PE of the market, 20 and a half, close to 21 times. There's not that many times historically where we have had this level. And when we have, it's usually been followed by some not so great moves in the market. You look from October lows, the P of P&E is up over 21%. The earnings component is only up 2%. So we're concerned about the valuations that are here. But you guys have been talking about the consumer this morning, the strength of that consumer and that momentum that goes along with it. We think you can't fight that in the short term, but we do think 6 to 12 months out, you are going to see the market pull back. That's what you have to be ready for.
Victoria, I want to just sit on this idea of cashing out or just trimming some of the exposure within the names that have done the best, namely big tech. How much is that purely a valuation play, and how much is that concern about what we were talking about earlier this morning with Google, for example, and generative AI and a model that they had to retrench because of some of the controversy there? How much are you looking at these specific stories about whether we've reached saturation points in companies that currently are the dominant ones, but may not always be?
Yeah, and Lisa, it's not just the saturation of that either. I mean, obviously you want to look and see, we say it was priced to perfection. priced to perfection for all of these things to work out exactly the way they should. Google obviously is an example of where that won't, but also looking at some of the cost associated with AI that I think a lot of people aren't taking into consideration. There is a lot of development that still needs to be done. We know it is nowhere near perfect, and Alphabet is a perfect example of how that's happening. And so there's still a lot more to go, a lot more cost associated with it. We don't know how much productivity is going to grow from this. We don't know how it's going to affect the labor force. So I think there's a lot of unknown questions to have such a perfect pricing mechanism on these names. So it's a combination of valuation, the stories that go along with it, and has the momentum that's been building in this equity market, has it created somewhat of an asset valuation bubble that you need to be prepared for?
So when you talk about preparing for it, you're not talking about wholesale selling or shorting or anything of that nature. And you talk about something of a tradable moment ahead of what is to come next, which you think is some sort of downturn or a much more protracted slowdown or weakness. So how do you know when we've shifted from this period of time where people are really enthusiastic, gung-ho, risk on, everything is priced to perfection or priced to nirvana or whatever? How do we know we're reaching that tipping point to what comes next?
Yeah, I think it's a combination of elements. Obviously, you want to watch consumer and the spending components that we're seeing there. You want to watch consumer confidence. Look, I know people want to ignore leading economic indicators that have been down for the last 23 months. But historically, there is a really strong correlation between the year-over-year change in LEIs and the year-over-year change in real consumer spending. LEIs are down 7% year over year. We should be getting a contraction in consumer spending coming up as well. And look, you guys have been talking about credit. We've got to watch credit spreads. They are so incredibly tight, not just investment grade, but high yield as well. That's kind of a canary in the coal mine for me, watching those credit spreads. When are we going to start to see some of those widen out? That'll also be a telltale sign. In the labor market, obviously, watch the open rates. When you start to see some of those open rates really come down, you'll start to see yields move a little bit higher. All of those are factors that we would be watching to tell us that might be the beginning of the turn there for the market.
I got to ask you then, if credit spreads are too tight, why do I want to own financials? Why would I like to go anywhere near them?
Yeah, well, I think you're looking a little bit out, right? We're saying 6 to 12 months out is when we think we're going to see some turning that's going to happen. Financials right now, because of the pullback that you've seen in that sector, you can go in, and I'm not talking some of the regional banks that have been struggling, but you look at some of those big money center banks. JP Morgan is our favorite name in this space. You can add some exposure there at a valuation that is quite reasonable, not just to the rest of the market, but to themselves historically. So I think it's just a more of an opportunistic trade to get into some names that have been pulled back, along with industrials that are starting to show some leadership, and the healthcare names as well. You're seeing some good trends in all of those three sectors.
I think JP Morgan traded at a record high on Friday. Does it not concern you that the CEO is selling stock?
No, it doesn't concern me that we're selling stock. When you look at that space and you look at the balance sheets, you know when we buy equity names, we are diving deep into those balance sheets. That is one of the strongest balance sheets that we see out there, and historically is sitting in such good shape versus where it has been in the past. We're not concerned about the health of that company. We think they will continue to be the leader in the space.
OK, good to catch up to get your thoughts, Victoria. Thank you. Victoria Fernandez there of Crossmark on the latest in this market. Here's a headline for you. Sony Interactive, Bramo Entertainment to cut headcount by 8% globally.
Yeah, which is about 900 people. And this comes as every company seems to be talking about efficiencies or cost cutting or basically trimming around the edges. We're not seeing that, though, in the numbers. And that, I think, is important to keep pointing out because the jobless claims keep coming in at real low levels, and we aren't seeing that increase in the unemployment rate.
You've seen a lot of job cuts in gaming, in the gaming industry. Sort of same thing at Microsoft, but they had a big acquisition, right? So I guess that kind of makes sense. The latest then from Sony Interactive Entertainment. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Expedia is cutting 9% of its workforce, speaking of job cuts, while it revives growth and market share. Expedia will cut about 1,500 jobs globally. Some affected employees were notified on Monday. Earlier this month, Expedia reported disappointing holiday results and outlook and announced a leadership shakeup. The U.S. FTC has sued to block Kroger's $24.6 billion takeover of Albertson. The regulator joins 8 states and Washington, D.C. in opposing the deal. They're arguing it would eliminate competition and lead to lower wages and higher food prices. The merger would also be the biggest U.S. grocery deal in history. Together, the two would have nearly 5,000 stores across the country. Alphabet shares fell almost 4.5% yesterday on, again, fears that Google's owners' missteps in AI are putting its search business at risk. The company paused Google's image generation feature last week after criticism over inaccurate historical depictions of race. Analysts have warned the problems may fuel a perception that Google is an unreliable source for AI and may create an opening for competitors. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Biden pressuring Congress ahead of a shutdown deadline.
The odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that they kick the can for a week or two with some more temporary spending.
That conversation up next, live from New York. This is Bloomberg. One hour, 13 minutes away from the opening bell in New York City. Equities lifting just a little bit, not even 1/10% higher on the S&P, lower by a single basis point. Your 10-year today, 426.78. Under surveillance this morning, Biden pressuring Congress before a shutdown deadline.
The odds we avoid a shutdown in the short term are pretty good. I think what ends up happening here is that they kick the can for a week or two with some more temporary spending. This probably passes. But the bigger question is, this is going to bumble on for a month or more, with the idea that by April 30th, there are mandatory 1% cuts if they can't come to a deal.
Here's the latest. President Biden set to meet with top congressional leaders in an effort to pressure House Speaker Mike Johnson ahead of Friday's partial shutdown deadline. That comes just 1 week before a full shutdown deadline on March 8th. Henrietta Trays of Veda Partners writing this: with 70% odds, we believe a partial shutdown is coming on Friday. But the bigger issue is March 8th, when $1.2 trillion in federal funding would be shut down. With 80% odds, we believe a short-term deal to keep the government open beyond March 8th will emerge, and another deadline will be scheduled for late March or mid-April. Henrietta joins us now to talk about those odds a little bit more. Henrietta, let's get into this. I talked about this a little bit earlier, I think, with Terry Haynes of Pangea Policy. What are the odds now for this speaker, with even thinner margins than the previous speaker, McCarthy, that he can make a deal and hold on to his job?
Well, I think that most Republican members remember how awful the October period was when they went 3 weeks without a speaker. And they went through their entire roster that time. You know, we went through Steve Scalise, Jim Jordan. There's not another member waiting in the wings that can somehow unify the wildly dysfunctional House Republican conference. And what you see that I think is most interesting is Senate Minority Leader Mitch McConnell trying to step in, Joe Biden stepping in and saying, look, y'all, you obviously can't run this ship. We're going to have to do another short-term extension. I agree with your last speaker. I think an extension to March 22nd makes sense. Even April 18th, we don't have a deadline of any real impact or detriment until May 1st, when the 1% sequester kicks in. And so, of course, by that time, we will have effectively kicked the can for a year, which is not all that dissimilar to the last several years, where we have just been going, stopgap after stopgap. So I think Speaker Johnson hangs on to his job at this juncture, but the big test is going to be in that mid-March to mid-April timeframe when they have to write a big package. And it does not include the policy riders on abortion that Republicans want, or on gun control that Republicans want, transgender care, et cetera. None of that stuff's going to make it through the Senate. That's how math works. And they're going to have to reach that reality eventually.
Well, when you look at those policy riders, if individuals in Speaker Johnson's caucus are not going to get those policy provisions they want, then why wouldn't they just continue to hold out and get the 1% cut across the board that will take effect April 30th?
Yeah, exactly. And that was supposed to be the mitigating factor. That's why Speaker McCarthy committed to it in the first place. That wasn't designed to hurt Democrats. That was designed to hurt Republicans a year from now. So in the interim, if we can get, an agreement that avoids these really aggressive Pentagon cuts, That's what McCarthy expected would really help Republicans find a path to yes without their policy riders on abortion or gun rights or transgender care. That's the hope. That was the hope last year. The calculus isn't working out because now those, very small cadre of far right Republicans, there's maybe 3 or 4 of them are saying, hey, look, I'm fine. If it trims $100 billion in federal spending, I don't care where it comes from. Unfortunately, members in those districts where there are military bases, where there's a Navy base, they have a real problem with it. And they're not going to go along with their colleagues and let those cuts go into effect. So you're going to need to rely on Democrats again, which, of course, is going to be a reality anyway, since you got to get the bill through the Senate.
Well, when you look at what the Pentagon spending is, it would be a big hit to the Pentagon. But we have the front runner for the Republican nomination for president talking about a more isolationist tone. Isn't that striking right now with letting the Pentagon take a hit?
It's interesting, though, because you want an isolationist policy potentially in some foreign affairs arenas like Ukraine specifically, but you also simultaneously want a tremendous amount of funding at the U.S. border. So, that's Pentagon. That's Customs and Border Patrol. That is additional police. That's more judges, more detention centers. That's still additional spending. So it really is a matter of being against reaching a deal. And the fundamental reality is that there's no bill that is capable of getting through the Senate that the far right would find acceptable. There's no level of acceptable pain or acceptable cuts. And that's been the case for at least a decade.
The president will also talk to leaders today from Congress about the foreign aid. When do you see that getting done?
Honestly, I don't see a big bill getting done until we have the run up to the sequester as our most immediate problem. I think that President Biden is going to be given a really good opportunity here with the Michigan primary underway. There's a lot of attention on the Muslim vote in that state that could potentially vote undecided or undeclared, rather. And the reality is he's up 70 points in that state versus his next closest Democratic challenger in the primary. So he's going to have a blowout election there. But this is helpful as a way to illustrate that, hey, there might be a ceasefire we can negotiate for Ramadan. We do continue to, have months have gone by since we've gotten an Israeli aid package from October 7th. We haven't got an additional Ukraine aid package, nothing to Taiwan. And I think an underappreciated part is the $55 billion in domestic aid that they're still asking for FEMA, for wildland firefighter pay. There's a lot out there that they need to get done. And he's trying to really compel them to move it forward.
Earlier this year, Henrietta, we talked about a good friend of this programme, Laurie Calvasina of RBC, who referred to client conversations about politics and this year's election as staring at the sun. And I just wonder, Henrietta, if that's changed, if your clients have finally sort of come around to the idea they need to begin to position for what could happen in November. And if they are, what on earth does that look like at the moment? What are they saying?
Oh, man. From my seat, people are very excited about it. There's a lot of dinners, there's a lot of lunches, a lot of meetings where people just want to talk about it. Investors trade as though the election were tomorrow, which, of course, it's not till November. So there's an internal power struggle that I have where I'm trying to predict November and they're trading on, day-to-day moves and when can they go put their basket of trades on around tariffs or on domestic tax policy. They're chomping at the bit for that. This is a huge volatility event and investors love that. So from my seat, I guess what I would say is that we are pretty close to fever pitch in terms of investor attention to this. There are people who ask that question amongst the investment community. So people will say, when's this really going to kick into high gear?
Yeah.
But from my calendar, I would say we're there. It's on.
I think on Wall Street, as you know, we like to reduce this down to one single issue. Have you noticed then we've already done that this comes down to if it's President Trump, it's massive tariffs. And if it's President Biden, they won't be as big?
No, I think there's so much on the line. I would push back on that. We have to get a tax bill. It will be almost $3 trillion. Just extending the existing tax rates is $2.7 trillion. So we have that whole litany of tax provisions, which is corporate and individual, whether it's, long-term giving and charitable contributions, SALT, the R&D tax credit. There's tons of that stuff. And then the tariffs, people are saying, what's the difference between the EU, the German automakers, and potentially a baseline tariff on Mexico? Should I insert the border adjustment tax as a placeholder? What is the deficit going to be? What do we do with bonds? There's a lot to play here. I don't think it's just a tariff story. And people are just trying to pick which one's going to come first.
Yeah.
And I think that timing is going to be important as we go, into October, November.
Amazing. Henrietta, thank you. What a year ahead. Henrietta Trace there of Vader Partners. We know which one came first last time around in the Trump administration, Volume 1. It was taxes and then it was tariffs in the second half of the administration.
Well, when you look at taxes, whether or not it's Joe Biden or Donald Trump, there will be an extension of the tax deductions because the Biden administration has talked about they want to make sure those under 400,000, maybe 500,000 are going to get tax relief. So already you're going to see additions to the deficit regardless of what president comes in.
Higher tariffs, bigger deficits.
Does
that scream short bonds
Okay,
to you? Higher yields?
Sure, yeah, you'd say so.
Sticker
but it's
inflation.
not but nothing's really worked out. It's just a frustrating conversation for me because we don't even know what the policies of Trump
It's all
would
right,
be.
calm down. Do you want to talk about mortgages?
Yeah, let's talk about that.
All right, tell us about your mortgage.
Is that how you're going to try to calm me down from here on out?
Just, you know,
3%,
relax,
just
deep
enjoy.
breath, talk about housing.
Okay.
All right, coming up,
Kumbaya.
a busy week of economic data kicking off with durable goods orders. Economic data coming up next. Equity futures on the S&P shaping up as follows. Seconds away from economic data in America. Equity futures right now just about positive on the S&P 500. On the Nasdaq up by 0.1%. Stage setting like this in the bond market. 2-year, 10-year, 30-year yields a little bit lower at the front end, down 3 basis points, 468.50. On a 10-year, totally unchanged, 427.76, and at the very long end, if you go to the 30-year, just about unchanged as well, 440.19. To work through the durable goods orders and to strip out maybe the air effect in all of this, the airplane effect, Mike McKee's with us for more. Hey, Mike.
Good morning, John. Well, it is worse than anticipated, down 6.1% on the headline. And of course, we did anticipate a 5% drop because Boeing didn't sell any planes, just 3 planes in the month of January. But even ex-transportation, it is down 0.3. So it is not a particularly good news. I'll look up the actual numbers in just a second here. But capital goods orders, non-defense, ex-air, this is the part that economists like because what goes into GDP. And that was up 0.1%, which is what was forecast. So it's not all bad news. Shipments up much more than anticipated, 0.8%. And that's good news because it suggests a stronger first quarter GDP number. And it, in combination, the capital goods orders and shipments suggest that businesses have not yet pulled back too much on what they're ordering and spending. Business spending, if it hangs in there, is what we want to see.
Mike, looking ahead now, we've got some house price data after this in about 29 minutes' time. An hour after that, we'll get consumer confidence numbers. We've been talking about it in the last hour. If you look at equity markets, all-time highs, you look at labour data, unemployment south of 4% for 2 years. Are we slowly starting to see consumer confidence pick up?
We are, and we should see it with the Conference Board numbers because we saw it with the University of Michigan numbers. Each one is designed a little separately, and Conference Board is more about jobs, and boy, did we see some good news on jobs the last time. Number to watch for in the Conference Board is people's anticipation of what their income is going to be over the coming 6 months to a year. If people think they're going to make the same or more money, then that suggests that they'll continue spending at the rate that they're doing. So that's something to keep in mind. This one doesn't have the political implications that the Michigan one does. They don't break it down by political party in the top line numbers.
And it's not as connected to gasoline prices as, say, the University of Michigan survey, which tends to track more closely. I do want to get your view on housing prices. There's been a number of discussions about how housing prices seem to have troughed and actually are re-accelerating, even despite the fact that you are seeing mortgage rates where they are. How closely is this something that Fed officials are watching and bringing up at a time where a lot of people are locked out of homeownership?
Well, they're watching it. They're not as concerned about long-term locked out of home ownership because they feel when interest rates start to come down, mortgage rates will go down. There'll be a pent-up demand to sell housing, and we'll see a lot more inventory come on the market. The problem right now is no inventory in existing homes because nobody wants to sell their 3% mortgage. And so people are just sitting there. But a lot of people want to move. They're retiring. They want to go to Florida, or they're young people who have kids and want to move up.
Too. Lisa's become so strategic now that she's not even saying it. She's just asking questions to get other people to say it. Mike McKee.
Well, here, let me give you one number here, just because everybody was wondering about Boeing and aircraft orders. New orders for non-defense aircraft, which is Boeing, down 58.9% during the month. So that's why your headline number looks so awful.
Not good. Mike McKee, thank you. Appreciate it. Equities right now still just about positive by 0.05% on the S&P 500. Joining us now to react, Dana Peterson, the chief economist at the Conference Board. Dana, wonderful to have you with us on the program, particularly with consumer confidence coming out in about 1 hour, 30 minutes time. How much should we read into this data? How much weight should we put on it, given the Boeing effect that Mike just went through?
Well, the key thing is core durable goods, right? And that really is an indicator of shipments in the present tense in terms of how well we're going to see business investment pick up in the first quarter and orders for the second quarter. So we know that businesses in our own survey are not really changing their investment plans. Whatever they plan to do, they're doing it. And if they didn't plan to do anything, they're not going to. But that's going to be a key thing. If businesses feel that the cost of capital is going to fall and that it's worth making those investments, especially given the degree of uncertainty we're expecting this year.
Dana, are you seeing business confidence pick up alongside a pickup in consumer confidence? Is that happening simultaneously?
Well, we do have our first quarter CEO confidence measure for the U.S. And yes, that measure did pick up. It was positive for the first time in 2 years. Businesses are looking at continuing to raise wages. They're still concerned about geopolitics. But they are still optimistic that there is good news for the U.S. economy going forward.
Dana, when you take a look at some of your confidence numbers in the past, how predictive are they of a downturn in the labor market that seems to be bulletproof right now?
Well, I mean, I would never take consumer confidence and slap it up against consumer spending. It does a better job telling us what overall GDP is going to do. And certainly we know that our measure was more optimistic than certain other measures last year because, as Mike McKee said, our headline includes business conditions, income, and employment. And our inflation measures, which people were very upset about last year, are separate. And we did see inflation really bother consumers last year. But inflation has eased, and we're seeing that in our numbers. And also we see that consumers, at least heading into this year and for the first reading of this year, we're feeling a little bit better.
It's hard to talk about this as a monolith, especially after getting Macy's earnings and then getting earnings from others, where you can see a clear bifurcation between families that have higher incomes and those that have lower incomes. How much is that reflected in some of your surveys? How much are there myriad audiences that you're reflecting in some of these numbers?
Well, it's interesting. We do ask consumers what they think by income and age, and there hasn't really been any clear pattern month to month. But there is this overall sentiment that we gather. And when we look at the data, and we're very much looking forward to the PCE report this week, are consumers continuing to spend real spending more than their real incomes? And we saw that certainly in the second half of last year. We also saw credit card use rise. More consumers are using buy now, pay later. So they're building up a lot of debt. And certainly that debt, the cost of carrying that debt is higher, given the fact that the Fed has raised interest rates very aggressively over a short period of time. And they're probably not looking to cut those rates probably until around June this year.
Dana, can you just explain that? Put that together with income. What does that debt profile look like relative to income?
Well, when we look at debt, I think it's good to look at the amount of interest that people are paying. And that has skyrocketed along with consumer credit card debt. And so that's a problem. And certainly we see this debt as being unsustainable, especially if we continue to see some weakening in the labor market, which we do anticipate. And also if wages don't rise as rapidly overall as what we saw over the last couple of years. So I think that putting all this together, we're probably going to see slower growth. This year, we no longer have a recession call, but we do have growth hovering around zero around the middle of the year, but then picking up later this year as interest rates come down.
We got a draft communique from G20 finance ministers. Bloomberg News obtained that. Just one of the quotes from it. We note the likelihood of a soft landing in the global economy has increased. They believe the likelihood has increased. How much of that, Dana, is just down to the growth numbers we've seen out of America over the last 6 weeks or so?
Well, I guess it depends on how you define soft landing. I kind of define soft landing as not going into a global recession and inflation gauges around the world returning to 2%. Or, whatever the threshold is or the range is for each economy. In the U.S., it's clearly 2%. But we never called for a global recession. We did say that there were going to be regional recessions around the world, and we've seen that throughout Europe, parts of Latin America. China seeing very slow growth this year. Japan dipped into a recession. So we are seeing these minor recessions around the world. We could continue to see that this year. But in terms of a global recession, no. And we are pretty confident that inflation is going to continue to decelerate. Certainly, as many central banks have hiked interest rates very aggressively, some are actually starting to cut. And we think that the majors, being the US and Europe, will start cutting interest rates probably around the springtime, middle of this year.
I'm struck trying to understand the blurry line between just a normal slowdown that will cause disinflation versus more protracted weakness that becomes problematic, which is why I think it's so interesting that RBC Capital put out their default and delinquency model showing a large increase in quarter-over-quarter credit card delinquencies. And after 3 straight quarters would bring us to 9 consecutive increases, 6 more than the previous record. Dana, understanding that this is up from 30-year lows in terms of delinquencies on credit cards, when does this create a real problem for this idea that the U.S. remains the bastion of growth that John was just referring to?
Well, we don't think that the U.S. is going to remain this bastion of growth. And we have to think about why the U.S. grew so rapidly last year. You still had the remnants of fiscal stimulus from the stimulus checks and lots of excess savings being spent down. Many companies did not let anyone go. And so many people continued to work, even though companies felt that there was something bad coming down the line. And you still had remnants of quitting where people saw higher wages. And again, you saw people using credit cards to supplement their spending. And yes, delinquencies are up, and it's also backing up into the banks that are issuing these credit cards. So we think all of that, and certainly the fact that the Fed, yes, did raise interest rates very aggressively, very higher than what we've seen in decades. And that's all going to come home to roost in weaker growth this year. So I don't think the U.S. is going to necessarily lead the global economy in growth this year. Meanwhile, Europe is probably going to see very weak growth, and China is probably going to ratchet down from 5.2% last year to something closer to 4% this year. So that all suggests slowing global growth this year. But then we do expect that there will be a little bit of pickup later on this year and also next year, as many central banks will be cutting interest rates, and that will help bolster economies, but not too much such that you see a reacceleration in inflation.
What do you think, Dana, is the bigger risk? That there is upside to this growth expectation in the U.S. or downside to this expectation?
Well, I think that I would say the risks are roughly balanced. Sure, you could continue to see people working, companies thinking that, well, the environment for spending and investing is going to improve, so we'll go ahead and invest. The housing market picking back up strength as mortgage rates come off ahead of the Fed cutting and then when the Fed actually cuts. But there are tremendous downside risks from geopolitics. Certainly, we could have further disruptions in supply chains. We're already seeing disruptions in the Red Sea impact Europe. It's not so much affecting the U.S., but certainly if we do have any disruptions in Asia, that's going to affect chips, which are in everything. It's going to affect energy prices. And so and also let's not forget the U.S. election in terms of how that may shake up policies around trade and also taxes. So there are a lot of uncertainties out there. So I would say the risks are roughly balanced at this time for the U.S.
It keeps coming back to that, trade and taxes later this year. Dana, thank you. Great to catch up with you. Dana Peterson there at the conference board, just explaining with Mike McKee a little bit earlier as well how dependent that durable goods data is on one company and what's happening with Boeing.
And how much they're just not selling planes.
At all.
At some point, they're going to have to start selling planes again, which raises this question, why isn't it sort of more closely overseen to make sure that quality control... You don't want to think about quality control in an airplane.
No, not when you get on a plane. You don't want to think about that at all. But we all are now, aren't we?
Well, do you still check what kind of plane
Boeing?
it is?
No, I don't. Yeah. I don't. But I think Brooks Sutherland was on top of it first. The cultural issues at that company. And I sense from the South Side, I want to be polite because this is not everyone who covers that stock, but I just sense from certain individuals who do cover that stock, they're reluctant to talk about some of the cultural issues within that firm because of the traditional old age issue covering a company, access to management.
It's also hard to quantify qualitative changes that really do
totally agree.
Shift a company in a dramatic way. But if you don't, then you're not able to address real problems. And that, I think, is what a lot of people are saying from Boeing. You need to quantify how qualitatively astray you've gone.
Do we have to X out Boeing when we get the next GDP print? Maybe. I mean, that's going to be
Boeing,
it's going to be Mike McKee's
Taylor
job.
Swift.
And then sort of include NVIDIA and all the chip spending and all of that. Mike McKee can break that down for you another time. Equities right now on the S&P just about unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The global economy has a growing chance of pulling off a soft landing. That's according to a draft seen by Bloomberg of the G20's closing statement at this week's meeting in Brazil. The text isn't final, but the draft says, quote, risks to the global economy outlook are more balanced. Upside risks include faster than expected disinflation. Global finance ministers are expected to arrive for meetings in Sao Paulo tomorrow. Shares in Altice gained as much as 63% in the Monday trade after Bloomberg reported that they were in the sights for a takeover by Charter Communications. Sources say Charter is working with financial advisors to assess the merits of the deal, but could still decide not to pursue the transaction. Both firms are suffering with the surge in wireless competition and cord cutting, with customers fleeing traditional TV in favor of streaming. Chocolate lovers could be in for a price shock with the cost of cocoa at all-time highs. Declining production in West Africa and upcoming new EU deforestation regulation have all contributed to the price jump of more than 50% this year. The new regulation requires chocolate makers to prove that every bean they import to Europe didn't contribute to deforestation elsewhere. It's a costly exercise that threatens to drive prices even higher. That's your Bloomberg Brief, John.
Danny, thank you. Up next, the state of the American consumer.
The Fed raises rates in order to slow the economy and arguably to break the consumer.
Do you want to say something about that chocolate story?
No, I'm waiting to hear what you have to say about that.
I'll tell you in a commercial break.
Sounds good.
That's coming up next. Not that. The other thing. This is Bloomberg. Stocks on the S&P 500 opening up in about 42 minutes' time. Equity futures right now positive by 0.1%. Yields up a single basis point, 428.94 on a 10-year. Under surveillance this morning, the state of the American consumer.
The Fed raises rates in order to slow the economy and arguably to break the consumer. But with the economy accelerating into the year end and the consumer still very resilient, it's not yet clear that the Fed has done enough to ensure that the U.S. economy gets back to a place of price stability.
Here's the latest in this sector today. Macy's beating fourth quarter estimates but issuing disappointing guidance as it sees same-store sales fall year over year. The stock is down 1.7%. CEO Tony Spring calling 2024 a year of, quote, transition and investment as the department store chain looks to close 150 underperforming locations to ward off activist investors. And Lowe's delivering stronger than expected earnings, even as it sees a continued pullback in so-called DIY spending. That stock also a little softer, down by 1.3%. Joining us to discuss is Joe Feldman of Telsey Advisory. Joe, just how strong are the headwinds for the likes of Home Depot, the likes of Lowe's?
Yeah, you're still seeing some pretty solid headwinds in the housing market and home improvement market in particular, where consumers spent a lot during the pandemic. We're now, coming off of that 2 years from the peak, and people are definitely moderating their spend there. They've been shifting their spend to other areas, which is a good thing, and I think it shows the health of the consumer is able to spend in different pockets. But home improvement spending for the near term, we think, is still going to remain challenged.
Can we talk about those different pockets? Are we still talking about those underlying trends of shifting away from goods and towards services? Is that evident here?
Yeah, I think you are continuing to see that shift towards services is still happening. We're still seeing, dining out, travel, and concert going, things like that are still growing at a faster clip than goods. And we're not quite back to that pre-pandemic level when you look at the mix of goods versus services, where services still has room to go in terms of some growth. And so we actually hosted a call yesterday with the CEO of Delta Airlines, and he talked a lot about just that recovery and continuing to happen. And we've heard that from Home Depot has talked about it. Probably going to hear that from Lowe's this morning as well.
This is where I completely veer off topic, but I have to go here because I have gone into Sephora and seen all of the 10-year-olds buying really expensive stuff, and I was struck by the idea that Macy's is investing more and expanding more in Blue Mercury and this sort of face care and just skin care craze that's going on. Is this lasting, or is this a momentary kind of blip that all these companies are trying to capitalize on?
You know, the beauty business, beauty, health and wellness, that whole business has been very strong really for the past several years and is expected to remain growing at a healthy clip for the next several years going forward. And so I think it makes some sense for companies to try to go after that. Now, of course, you've got Sephora, you've got Ulta, and Walmart and Target and everybody else in between doing all this and trying to go after that market more aggressively. And they're seeing good growth in those categories. So I understand why Macy's would go after it. They bought that asset with Bluemercury, and they would like to try to do that. But as you just mentioned, we're hearing more and more of young tween girls with like 10-step facial regimens every night. It's kind of crazy, but that's I think what social media has done these days to kids.
Yeah.
And with that, though, that means more spending on health and beauty products.
I just wonder where they get all their money. I mean, I've walked into Sephora and seen these girls just absolutely mobbing the place. All the more power to their 10-step routines. I am curious, though, about this question around where discretionary spending is. You're laughing at me, but where the discretionary spending really is going. Is this because of strength in the consumer, or is this because you have higher income families that are able to go out and have this as an experience versus the people who are running out of discretionary spending on the lower ends, not really buying goods as much?
Yeah, I think that's a great point, where you are seeing that split, where the higher end, more affluent consumers are definitely the ones that are traveling. They're the ones dining out. They're the ones spending on some goods as well. And whereas at the lower end, you're definitely seeing more cash-strapped consumers making choices about what to spend on, seeking value. We're hearing from all the grocers, whether it was Walmart last week, I'm sure Target next week, and Kroger and everybody else, talking about the fact that people are stretching those dollars further. They're opting for private label brands on food side of things a lot more often. So this is not to say that everybody's doing better, but even that low-income consumer, they generally have a job if they want one, and they've seen some wage growth. So that's why I think there's some comfort that the consumer can sustain some spending levels going forward into 2024.
Well, to Lisa's point, Macy's adding Bloomingdale's and Bluemercury, but cutting back on some Macy's stores. Can we see the fact that maybe some of these organizations that have higher end and lower end just go into those, and we're going to see a hollowing out of middle of the road retailers?
Yeah, that is a big concern that we have. And you've actually been seeing it for the past, decade, where the department stores have slowly been ceding share, and the winners have been at the two extremes. It's been the brands at the higher end, some of the luxury brands, and then the off-pricers like TJX and Ross and Burlington, who have done quite well capturing some of that market share, as is Target and Walmart. And they've been picking up that portion of the consumer base. So I think you're right. You're seeing the middle is under a lot of pressure, which I think is reflective in some of Macy's moves. I think we've seen some of the pressure at Kohl's, and certainly some of the other department stores have been weak, and we've seen some go away. So yeah, that hollowing out of the middle has been a bit of a problem, which is concerning, because go forward, you still need that offering for the consumer. I think they're starting to find it at the Targets of the world and again, the off-pricers.
Joe, before you go, top pick then. What is it? Is that where you find it?
I still really like Walmart, and I really like Costco. I think they've kind of got both ends covered. You've got food, you've got general merchandise.
Yeah.
Execution has been good, like those.
Is the regulator doing them a favour by blocking this deal, potentially, with Kroger and Albertsons?
Yeah, it'll be interesting to see what happens, because, the regulators have not been very successful in the courts in the past few years. If you look at some of the other big transactions that they've tried to block, it hasn't worked. Every deal is different. After the combination of Kroger and Albertsons, Walmart is still going to be a good bit larger, almost 10 points larger, depending on which market share estimate you look at.
Yeah. Joe, great to get your views. We'll have to talk about that another time. Joe Fadman there at the Telsey Advisory Group. Just about enough time to have some final thoughts. We can do influencers. dreadful people, getting people to spend more money on makeup and skincare regimes. We can do the Europeans going after your chocolate. We should do that story. What else would you like to do?
I personally find it fascinating that we have this narrative that might be false about the lower income consumer and the upper end consumer. What we heard from Dana there, Dana Peterson and Joe Feldman, is that it's not that clear cut and they're not finding those trends. And I find that really fascinating.
Well, it's part of the reason why when you look at what's going on with Kroger's and Albertsons, I think Joe made a great point. He likes the Walmarts because and Kroger cannot compete. And when you heard from the spokesperson come out and say, these are the companies the FTC should be reining back, and we are trying to compete with them, and we can't. There's one thread on this, Jonathan. You've asked a lot of guests around the table this question. Would it change if Trump became in power? There's one union that's against this deal. That's Teamsters. And they recently gave, bucking decades-old president, recently gave $45,000 to the RNC.
All I was going to say was the other takeaway is, where do 10-year-olds get $182 to buy antioxidant treatment?
Is that how much it is?
For 1 fluid ounce from Blue Mercury.
It used to be go get a chocolate or ice cream. Now it's go to Sephora.
And
get a
they go
lipstick.
in, it's like they hang out, but they're all waiting in line buying that.
You thought Gen Z was bad at work. Wait another 20 years. Imagine how bad it's going to get. Spoil. Coming up.
That's your final thought?
Jonathan Stubbs of Berenberg tomorrow with Qualcomm CEO Cristiano Amon, Mark McCormick of TD Securities, Greg Dacko of EY.